Welcome to the monthly IBD Meetup. My name is Roy Maddox, and Wes and I are the hosts and facilitators of the monthly webinar. This meetup is sponsored by Investors Business Daily, and we happen to have one of the largest meetup groups in the country, approaching 2,000 attendees. I have been employing CanSlim tactics for over 34 years, since 1988, when I met Bill O'Neill and David Ryan at a webinar. And really that changed my life. Before we move any further, if you're not on our email list and would like to receive our comments, just go to the chat box and leave your email address, or Web will send a link and you can fill that out and we will add you to our link. We're a private meetup group of really ardent investors who know with certainty that the equity market can provide you with financial security and change your financial destiny by identifying and purchasing a few true market leaders. Many of us have done so. Now, we haven't done so recently because we haven't had any true market leaders in the last year and a half or almost 2 years. We're like-minded investors. We don't believe in buying and holding and riding stocks down. We believe in managing the downside and cutting our losses short as quickly as we can. There are obvious times to be in the market, and there are times to not be in the market. There's times to be fully invested, and there's times to make incremental exposure in the market. Now is the time to certainly be making incremental changes in your portfolio if you have a bullish bias. And we will be talking about the follow-through day that happened last Thursday, and we'll be providing some color in terms of what you might expect in the market over the subsequent weeks and months. Tonight, we'll be talking about a lot of concepts that come out of the book, How to Make Money in Stocks. That, of course, is Bill O'Neill's famous book, where he provides an educational outlook of stock analysis using his famous CanSlim concepts. Tonight's agenda will be also divided into a couple of different sections. After this preliminary introduction, we'll go through our slide deck, and then we'll have a special guest, John Roach, who is a dear friend of ours, who will be providing his color on the market. So that should be quite interesting, and that will be coming on at 8 p.m. tonight. After then, we'll answer any questions that you have, and we'll probably talk about some individual stocks as well. This group is a highly educated group, and we have many experienced investors on this call that will be sharing their opinion. And we certainly think that you'll enjoy the opinions of others, certainly in light of the volatility that we're experiencing in the market today. So let's get started. A little bit of information about our IBD Meetup group. You can find us just simply by Googling the Charlotte Investors Business Daily Meetup group, and you can sign in there to join the meetup. This is a background on John Roach, who's really got an esteemed background with a wide range of experience with a number of firms on Wall Street, and we're looking forward to his comments tonight. Of course, the content in this presentation is for informational purposes only. It's not to be construed as investment advice. We recommend you talking to a licensed professional in terms of making your investment decisions. The CanSlim acronym, many of you are familiar with this acronym, and that we use often to help identify the true market leaders. It's important to have a process in terms of designing an equity strategy and a portfolio, and an equity portfolio. And we believe that it's crucial to look at the technical analysis aspects, the fundamental analysis aspects, and also the macroeconomic analysis. We think there are three important tools that should be utilized in designing an investment process. Technical analysis, I won't spend a lot of time on this in terms of clarifying and defining what all these are, but we will be looking at a number of these measures, and a lot of this information will be on our charts that are forthcoming.
Yeah.
Some additional information on the CAN-SLIM process, and this is basically the screening process that William O'Neill identified that represented the top leading stocks over the last 50 years from his study back in the 70s and 80s. The macroeconomic analysis, we use Keith McCullough for our macroeconomic analysis, and we think it's important to look at the macroeconomic analysis because this has to do with the GDP growth, inflation, and of course the Fed policy. And Hedgeye has done a wonderful job in terms of putting algorithms together to generate forecasts to measure and forecast what GDP growth is going to be and what inflation is going to be. So currently their forecast is that we're in a quad 4 quadrant where GDP growth is slowing and inflation is decelerating as well. This is really the worst type of market environment that you can be in when the economy is in a slowdown and when the Fed has a restrictive policy. It's important to look at what industry groups do well based on where we are in the industry cycle. So you can take a look at this and study this. And we'll actually be sending out this slide deck tomorrow if you're on our mailing list. So you can study and see what industry groups typically perform the best and what perform the worst in a slowdown that we're experiencing currently. Okay, basically everyone's on the call to really want to know what our forecast is, and we think that this is a great chart because it shows over the last 70 years what the average bear market is, the decline, the average bear market with no recession, and then the average bear market in a recession. And this is important because we really think that growth is going to disappoint in the first quarter, and that the S&P is vulnerable for another 15 to 20% downside from here, and that most people aren't prepared for the recession. And even those that think that we're going to be in a recession, they're not really on the sidelines, and we are. And we're still 100% in Treasury bills, and we don't think that there's enough information out there to warrant putting money back in the market yet. However, CPI is going to be reported Thursday, and the momentum or the lack of momentum will dictate really probably what the next step should be. Should you add exposure or reduce exposure? It all boils down to the Fed, and most people believe, most bullish pundits want and believe that the Fed is going to pivot, and we are, we're reading his lips. Basically, we're reading Chairman Powell's lips, and we think that they're going to raise rates higher than people expect, and we think that they're going to last, they're going to stay there longer as well. And in an environment like that, that could be catastrophic and lead to the next leg down. When you compare the bear market that we've been in today to the 2008 to 2009, 2007 really to 2009 bear market, looks very similar. And also it's similar to the 2000 to 2002 bear market. So you have to be prepared for profits to decelerate in the slowdown. And if that happens, which we think that it's going to happen, we think Wall Street's estimates are too high. We think that the valuations are going to go lower. And that's simply using the math. Right now, the estimates are about $230 on the S&P for this year. And we think that when all is said and done, the estimates are going to have to decline to $200. And if you put a PE on that, if you put a 15 P on that, that means the market's going to be at 3,000. David Tepper actually came on last week on CNBC, and he thinks there's risk to 2,400 in the market on the downside. And you have to be in this bear market. You don't want to try to make up all the losses overnight. You want to make sure that you're on the right side of the trend. And we're only 5 days off the bottom of a closing low on the NASDAQ. So you haven't missed anything yet. And there's really not a lot of leadership in the market. Most breakouts are failing. And it looks like things are rallying like 2 or 3 days. And that's just too short term of an environment to really make money consistently. It's very, very challenging and very, very volatile. We did have a follow through day, of course, last Thursday. So we're right off the bottom, and this demonstrates what that looks like. And if this follow through day fails, I think this would be the 8th follow through day that fails. And by failing, it would have to undercut the low of the follow through day. And that looks like around 10,250 or so right there. So that's an important area to focus on. If we take that low out, I think I made a tweet the other day where I noted that the barnyard will be open if you take that low out. So that's a very significant area. And I think it could be event driven this Thursday. I think the estimates for CPI on Thursday are 6.5%. But Hedge Eye Research and Keith McCullough thinks that the numbers can be more like 6.7. And with a miss like that, that's going to change the whole narrative. And people that are looking for a bullish pivot, it's not going to happen. So that's I'm looking for Thursday to be extremely volatile. And it's a day where we just don't feel like we're going to go into the day with that event risk personally. And with that, let me go ahead and turn the slide deck over to Wes. Wes, why don't you take over from here? And then, of course, we've got John Roach coming on at 8 p.m. tonight. So, Wes, you want to take over from here?
Yeah, will do. If you can stop sharing first.
Okay.
Thank you. So yeah, we're excited to have John come on later. Should be joining us at 8, and he's got a lot of experience, a lot of insight, and just very entertaining, I think, to listen to. He's got a lot of stories, a lot of 80s analogies to help get his point across. So, look forward to seeing him shortly.
And we did have a question regarding a follow-through day. A follow-through day is a day in which one of the major averages, primarily this S&P 500 or the NASDAQ, is up 1.7% on higher volume than the day before. And you have to be in a market in a correction when that happens. And what that does is it shifts the narrative from a market in a correction to a market in a new confirmed uptrend. So we are in, by definition, a new confirmed uptrend. But whether or not this is a bull trap or not, we're going to find out shortly, because, again, as I've said, we've had 8 of these that have failed. And with significant fundamental information and earnings to come, we think that there's just a lot of risk in the market currently.
Yep. All right. Yeah. And so just a quick look, so recap for everyone on CPI, since it's coming up Thursday. The last 12 months here of history peaking in June last year, and coming down quite a bit, right? So that is meaningful progress, but a like Roy said, we're reading his lips. He says, all right, he's going to stay, Jerome Powell is going to stay restrictive. And it seems like longer than people are willing to admit. So no one wants to, give in and totally believe what he's saying, but he hasn't wavered for, the last, I don't know, 9 months since he's really put on his Volcker hat. So, yeah, that's what we're going to take him at his word, and there's that chance that he's going to stay higher for longer than people are ready for. And like we mentioned earlier, the inflation forecast that we're looking at from Hedgeye, they have a quarterly estimate here of about 7.2% for the quarter, which encompasses the previous months as well. And so that gets you somewhere in that 6.7, 6.8 range, maybe for the quarter or for the month of December. And the latest consensus we're looking at is about 6.5%. So just that event risk, it's been extremely volatile the last 3 or 4 of these reports. People are staring at it and know it's important. So why really take the event risk? If we bottomed and if the follow through days kind of kicked off the next leg, we have plenty of time to get long. So we've seen this enough over the last 6 months with these events just to stay out. So that's what we're currently doing. And the next talk is kind of the Fed pivot, and maybe a pause as a pivot. I'm not sure if that's considered a real pivot, because they've been broadcasting this for the entire year too, that they are going to pause at some point and slow down the pace. So this is just looking at the Fed funds futures for next year, and it looks like we get another hike in February. It's February 1st. Then we get another hike in March, and that's potentially the last hike that we see. It's kind of unclear. Maybe there's one more in May, but right now the market's pricing in a peak at about 5% for the Fed funds, and then declines by the back half of the year. And so maybe that's the pivot. But if that's a pivot, it's not very meaningful, and if anything, it signals that a weaker economy, right? They're going to have to respond to a weak economy, and that could be what's happening here. And what we looked at this, I believe, last month, Fed pivots and market reaction. So if you want to pull up maybe that prior slide deck, if you have that, that's an interesting chart. It's not like there's a clear, market bottom when the Fed finally does pivot. But okay, here's a look at interest rates. This has been obviously a huge headwind to the market too, throughout 2022.
Wes, excuse me 1 second. What slide are you on?
I'm on slide 16.
Okay, I'm on slide 13.
Are you? Can anyone?
On my screen, it shows you're on 16.
Okay, we're showing.
Oh, it is. Okay, you're
okay. We're back. You see that? Everyone's good. All right, great.
Okay.
Yep. So just looking at the rate environment, still 3-month continues to climb, right, as it should, with Fed funds continuing to rise. The 10-year less clear, right? Maybe we got a peak in the long end of the curve, possibly. That's again, we've kind of talked about longer term treasuries becoming somewhat more attractive here at this 4% range, but you really don't know if there's one more move up, right? If inflation does persist longer than we expect, then and it kind of stalls at this 4 or 5% range or something. That's just gonna mean the long end of the curve is gonna have to respond to and go a little bit higher. But it's something that we're looking at. The short end should be peaking. We should be getting close to a peak. I think I don't think the market has it wrong that the Fed is gonna stop. But and then we've talked about this yield curve. This is a famous recession indicator in the future. Leading indicator of recessions. This is as deep as of a inversion that we've seen for 40 years. So one thing that obviously keeps us cautious on the macro side. This is a signal that we should see slowing growth in the near future. Okay, here's a look at the S&P. Like we mentioned, this follow through day, right, just on Friday. Not great action immediately following it, and actually, I guess on the S&P, not even a clear follow through day, but more so on the Nasdaq. So not great action. This long tail. We're still kind of right at that 50-day. We're below the 200-day. The 10-day hasn't crossed over the 21-day. But and we'll see a couple other indicators where we're kind of overbought on a short-term basis. Yeah, and just pulling up the Nasdaq and MACD. We actually are on a buy signal for the MACD. So some improvement there internally, based on that indicator. And then just zooming in further on the Nasdaq and the moving averages, right? Because our moving averages being our number one sort of indicator of trend, right? Our the way we determine direction of trend. This has been a pretty short bounce thus far, and so it's just not not enough has really happened, right, to say that the market has meaningfully changed direction. We did get that follow through day. This could be a tradable rally, like we've seen, like we saw a few tradable rallies last year. It's yet to be seen. Some good action today, some I think negative action yesterday with sort of rotational action that we're seeing, right? Everyone's probably saw the biotechs. So there's just still a ton of heightened risk out there, right? Because all these biotechs, that was the leading group, right? Or one of that and solar were leading groups, and then you just saw a lot of those kind of fall apart in the last couple of days. So still just being careful here and not a meaningful change in trend.
And Wes, let me point something out on that slide as well. And so you can see the follow through day that was Friday, Monday, Tuesday. So you can see the big day there, right there. And if we go back to the slide before, you can see where the MACD turned positive. And the MACD, it's a momentum-based indicator that's quite commonly used in technical analysis parlance. And it suggests that the momentum, that we're pretty exhausted, on a short-term basis. And so we just went to a buy signal yesterday. Now, the stuff that is bouncing off the bottom, it's the stuff that's been hurt the most. This is the third worst bear market that I've experienced in over 3 decades. And we have many stocks, particularly in growth, that are down 70, 80, 90%. So what remains to be seen is where's the leadership going to come from? And keep this in mind, if we're going into a recession, that's when growth outperforms. And where PE ratios should be expanding because companies they're valued differently because they're long duration assets, and companies are investors are willing to pay more for the slower growth that's coming in the market. So you have to be careful and that's really what's happening right now is we're having this up and down tremendous rotation from growth and value, and there's just a battle going on. But we firmly believe that the QQQ, the NASDAQ 100 won't see new highs for many years, and we think companies like Tesla they're going to underperform for a decade. So this is not really where you want to be. You want to try to concentrate on the stocks that have high relative strength, the stocks that are making new highs, and the new high list is your go-to list in the current market environment. Coming out of this bear market, I'm telling you that this is going to set the stage for a tremendous upside. We just don't know if we've seen the low at the market right here from a valuation perspective. So the verdict is out, and really no one is going to know. So we don't know if the Fed is going to hike longer and higher than they're saying. They're clearly saying that they are going to hike higher and longer, and that we're going to hit a 5 to 5.5 Fed funds rate. But many professionals don't believe that. They believe that the Fed is going to have to pivot. But even if the Fed pauses, and that's not necessarily a pivot, but the bullish advisors out there are going to say, hey, the Fed is pivoting. But by pivoting, truly it's defined as when you're cutting interest rates, not just stopping the interest rate rises. And I think Powell is not going to pull a Volcker and make a mistake by cutting interest rates too soon. And I think that they learned their lesson by saying inflation was transitory. So I think that they're going to go overboard. So that's the downside risk that you have to be prepared for. And we're aware of that. And that's why we think that you have to be meaningfully defensive at the moment. The coast is not clear yet.
Mhm.
Okay.
Excellent. So
Roy,
yeah.
Roy, it's Larry. One more question back on the last slide.
Oh, here.
Yeah, thanks, Wesley. Hey, I know what you just talked about, and it makes perfect sense to me. But my looking at chart patterns, looks like we've been at like the 10,250 level now 3 times. Is
Yeah.
that significant in this at all?
Actually, it is significant, and it's significant from a bearish perspective. So anytime you put triple bottoms in, when you go back and you look over history, that's not a favorable environment. That's a very weaker environment. So that's not a bullish. We're in the market's off the bottom over the last 3 days, but that's not necessarily a bullish undertone.
But yeah, wouldn't you say, I mean, the more times you hit support levels, the more significant that particular level does become. So I would think a break of it, it becomes
Yes.
super significant.
Right.
You can see the support here, right? I mean, that is what that is with people buying at this level, that was established with that was a CPI report too, I'm pretty sure, right? That was
Yeah.
I mean, I think that if we break it, that's not particularly good.
Guys, let me just say also that there are a lot of different ways, as to skin a cat. And, our methodology doesn't necessarily, fit into the bottom fishing aspect. I mean, you can, as traders, you can trade anything that you want to trade, as long as you've got a tight stop there. So you could trade growth value. You could buy stocks that are beaten up, that are turning, or you could buy stocks making new highs. What we do know is that the current environment is an environment that's treacherous because breakouts are failing. And we're not going to have a brand new bull market until you have a plethora of breakouts that they break out and they continue going up. But we've been in such a rotational market that the prior leadership were solars. Those got hammered. And then we got just, a few days ago, we had biotechs that rolled over in large mass. So we don't know where the leadership's going to come from. We need more time, and it'll be new groups, but I don't think it'll be cyclicals. It will be brand new leadership groups, and they haven't presented themselves yet because the new high list hasn't expanded yet.
Okay. And so just moving on here, we have another chart here, the NASDAQ and the 30-week average, Stan Weinstein's preferred, long-term trend measure, still below that. So, if you're just going to be simple and go, believe in his stage analysis and everything, and, his method, he would, there's no reason to be, again, heavily invested. We want to see that close 2 weeks above the 30-week average. And the NASDAQ being, the weaker of all the indexes, we'll see the S&P here, which, has closed above the 30-week average a couple of times. Recently, it's right here at that 30-week moving average again. So, I don't know, it's in an important level here. it's yet to be seen, right? But the the long-term trend remains down. Let's see, the S&P and this looking at the stocks above their 50-day moving averages. So we've certainly seen some improved breadth since October, the October bottom, and another bump up in the last few days since the follow through day, where we're at 68% of those stocks above their 50-day moving averages. And here's a look at the stocks above their 200% or stocks above their 200-day moving averages. And I drew these lines just to show sort of a positive divergence, right? We're seeing more stocks kind of improving based on this trend level, this trend measure, while the index is making a lower high. We're actually seeing some positive trend changes underneath the surface with stocks that are creeping above their 200-day moving averages. All right, and just looking at the NASDAQ, again, some improved breadth. Yes, we have 52% of stocks now above their 50-day moving averages. Not the same as the S&P like we've seen the last year, right? The S&P has been the stronger of the two, so we're just not seeing as much participation here still. But I sort of a similar look at the NASDAQ and the percent of those stocks above their 200-day. Right, we've got some significant lower highs in the indexes, but beneath the surface, the stocks above their 200-day moving averages, not making, I guess, higher highs like we saw in the S&P, but at least not making, at least kind of bucking that trend of lower highs like we're seeing in the index, right? So just kind of chugging along here as far as stocks. So we have maybe some improving action under the surface.
Hey, Wes,
Individual stocks.
last time when we talked about it, this is exactly what you guys described what would happen. These are all the big mega caps that
Wait,
are
Larry.
falling out of bed at the end of this bear market. You said how
Larry,
is.
sorry, can you turn to your left?
Oh, sorry, I forgot
Yep.
about that. Yeah, this is exactly what you said it would be in our last call. Is that these mega NASDAQ caps like Apple and Microsoft and Google and all those guys were going to fall out of bed, and that was going to be a great symbol for kind of the end of the bear market, because these are the last guys that
Yeah.
most loved stocks fall out of bed last.
Yeah, and Larry, that's a great point. And this is just some light at the end of the tunnel when you're looking at this breadth indicator. So for the first time, and particularly in the S&P, that's really where you want to concentrate, and not the NASDAQ. But these numbers are starting to firm up, even though the averages they're not off the bottom significantly, particularly with the NASDAQ. So the big, the leadership's going to be coming obviously from the S&P, not necessarily the big FANG NASDAQ stocks.
Who is he?
Yeah, did you have a question?
Not sure.
Yeah.
Nope. Okay.
Okay.
Yep. And speaking of improved breadth, we did note this chart. This is something that me and Roy were talking about, I think yesterday. One of the more important charts that we have in here, where you're seeing some net new highs, right? We saw net new highs for a few days back in August, but now we've seen this string of 5 days or so, 6 days of some improving action, right? So we've got some highs outpacing the lows. And that's an environment where you can actually make money in stocks. And looking at this longer term, again, this is a 5-year chart looking at the net new highs and net new lows. It's been a prolonged period of net new lows, and the thing we want to take away really from here is, right here, this little blip is week 1, right?
Yes.
It might be week 1, and if it is, we have many months to go of this, so we're not having FOMO, right? if the environment changes, we'll have plenty of time, but this is, could be the beginning, right? So hopefully, it is, and we're happy, we're happy to get invested more, but even longer term, to put it in more perspective, whenever we do have a prolonged periods of net new highs, it's for a number of years, right? It's so that's what we have to keep in mind. Good improvement, finally seeing some net new highs, and it's encouraging. Now McClellan oscillator, we're pretty overbought in the short term based on this this oscillator, so keep that in mind. We had the follow through day, we had a couple up days since then, and it's just obviously don't chase a lot of stocks that have worked have really run up in price quickly. Joseph, you mentioned AEHR, for instance, right? Like obviously that's super extended, so a lot of them have run up quickly. And okay, on the VIX, we showed this also, I think last month. We talked about potentially seeing that breakout to new highs, and but of course it's been super low. Or it's really been bottoming at this 20 level for the last year. Between 20 and 30, 20 and 35, what Keith McCullough calls the chop bucket, which we've all been aware of, getting chopped up for the last 12 months too. So right here at 20, again, we'll be seeing what happens with Thursday. Like, we do think Thursday is probably a market moving event, the CPI report. And when the bull market does happen, right, we're going to be steadily declining below that 20 level in the VIX for many months, and that'll be when volatility lowers, that's when we can really get concentrated in stocks and not get bucked off the horse. Did you want to add something?
Yeah, I'll just say typically, well, it's an anecdotal indicator, but we've been waiting for this VIX to spike. The way that it spiked in prior bear market bottoms, like in 2020, we were at 80, and you can look at the 2018 bear market, and then the 2008, 2009 bear market, 2002 bear market. You typically have spikes. So if you've got a bearish thesis, and we've got some great information here. We've got some breadth that's improving. We've got new highs that are beating new lows for a week, and we've seen more participation. So what could happen is you could have those averages take one more leg lower, but you would have a great positive divergences between stocks that aren't making new lows with the averages, and that would signify to us that truly we truly are at the bear market lows. But it's going to be earnings season, and really the first quarter is going to dictate, I think, the short-term direction. But this is something that we've been waiting for. If we would have a spike of the VIX back over 40, 50, 60, certainly that would suggest to us that that we could be carving out the low of this bear market.
Yep. Yeah, and you mentioned earnings, which is something to obviously consider coming up. Right, Friday we have the first reports, and I think what's going to be interesting too is I think a lot of companies don't want to give guidance for 2023 or haven't wanted to, right? But now at the fourth quarter reports, they're kind of expected to. They have to give some kind of guidance. So that'll be important, right, for people to for companies to finally give their best outlook, and we'll see how it fares to whatever consensus numbers are. And we'll get back to the put call. I also want to ask about put call. We'll talk about that shortly too. But here's another chart that we look at regularly. It's about the active manager exposure index. So this is a percentage long that active managers are, and we're sitting here at 39% net long for this survey. Low, right? It's definitely historically a low level. And we did get to a low that was pretty close in late September compared to the March 2020 bottom. So this is another contra indicator right there. We're super underinvested, or active managers are underinvested, which of course fuels up moves as they get more exposed. And now looking at the bull and bear sentiment, this is the AAII bull bear survey, right? So we've got 42% of respondents as bears and 20% as bulls. I mean, there's not an extreme level of bears here, right? That's come down. It peaked in October. Well, I guess that's late September, where it surpassed 60%. And I think everybody on Twitter, had something to say about, wow, when's the last time that happened? But not a lot, I don't think, to say here. No extreme level of bearishness at this point. But also, this level of bullishness is very low, and it's staying steady at that low level. So I'm not sure, this is sort of an extreme indicator that you want to look for, or you want to look for extremes, but and it's a poor timing mechanism, but just more to consider here. And now looking long term, where this is a net bull versus bear number in the bottom panel here. So net bears, when you're red, and net bulls when you're blue. Historically long period of net bearishness. And again, this is why it's a poor timing tool, right? But just to understand how people are, their sentiment. It's been a very long period of bearishness, comparable to that 08-09. And like we talked about, we're defensive, we're cautious because of the macro environment and what could happen. And notice that there's this in 08, there was a very prolonged point of bearishness before the kind of the credit crisis spurred the next move lower. And that might be what we see, right? That might be something to look out for, right? So we will be, it's important to monitor the credit situation. There are a number of stocks out there that were beneficiaries of free money over the last 2 years that are not profitable, may never become profitable, may have debt that they'll have to address. They may have debt problems that they'll have to handle, or just go out of business entirely. So that's still the risk there, especially as rates stay higher, and people are just less willing to lend. Someone asked about the put call. This is a pretty impressive spike in the put call ratio. I don't know what to make of it, or if I need to even consider it, really look into it much. I believe this day was December 24th, though. I think the peak of it was Christmas Eve, I'm pretty sure.
And it was an option expiration day where you had future stocks, options, everything expired that day. So that could have had something to do with it.
Right. And I know we don't sit here and pick apart these spikes, right? So it's like, I don't want to try to look for a reason why it shouldn't be meaningful. It might be very meaningful, right? That's pretty serious right there. But when we were looking at the VIX, right, the VIX shows nothing like that, right? This is at an all-time high. This equity put call ratio surpassed the 2020 bottom level. But the VIX did nothing. So to me, it seems like a very noisy piece of data when you don't have, the VIX should be telling the same story, right? It should be confirming that action. So I think something seems off by that, but we've been talking about that spike. So here's the spike. Maybe that is an important bottom. Okay, and this is a measure that of high yield spreads. This is what we're looking at for credit risk. when there was more concern about credit risk back in June, July, we saw that credit spread get to 6 percentage points based on this index. If there is more credit risk out there and the markets see that happening, this is what we're going to see move. We're going to see this move higher. So, it's just something that, another thing that we suggest everyone kind of keeps an eye on to make sure they get a full picture of, of each asset class. Okay, we have just a few more here. We want to point out this all world index, excluding the US. Definitely an interesting chart. It's the international markets have been a little bit stronger than the US recently. It's blown past, it's blown up through its 50-week, 200-week moving averages. And something interesting, there's a couple of individual components that are interesting. I think Mexico might be on some of you guys' radars. I think that might be at an all-time high recently. And, the narrative there, I guess, is the reshoring or perhaps, away from China back into Mexico. But, you can't argue with the relative strength. So, something to look at, right? We can go anywhere. We're retail investors. We can look at anything. So we might as well. Okay, and gold may have been flashing on some of you guys' screens recently. A lot of relative strength. I would probably overbought here at this, after this big run up. It's something that it's an asset that I think's been kind of difficult. It hasn't worked throughout it didn't work much during 2022, while we would typically expect it to in a bad economic environment. But here it is working finally the last couple months. I suspect that John Roach will touch more on gold. He's always been he's been I think better observer of gold and other metals than I've been, and it's something that he's been paying attention to for decades. So I'm sure that some of his slides that he goes through today with us will include gold, silver, miners, but we'll have to see. And I wanted to include this this longer term gold chart. This has been highlighted before. We got faked out early this year, right? It's just this beautiful Brobdingnagian base, another term coined by John, brought a base from Brobdingnag, just meaning massive, huge base, and we love big bases, is what he would say. So, if we do make that move above 190 again, we'll see. It might be in for another meaningful, multi-year move higher. Okay, and here's a look at the dollar. The dollar just had a fantastic 2022, really, up until the last quarter. Big breakdown in the US dollar, down. What are we down? 15% from the peak. And this is probably largely fueling some of that gold rally, right? The weaker dollar and the gold correlation there, clearly showing the strong inverse relationship the last 3 months. And we just have one more here. We were talking about the long end of the curve for Treasury bonds. This is an obvious kind of liquid, highly accessible ETF to get that exposure to the long end of the 20+ year Treasury bond market. And so this is a recession play, right? This is the way to make a lot of money if in the event that we go into recession. The long end of the curve should be coming down to reflect that lower growth and lower inflation that would be associated with the recession. So this is something we're looking at. I think it would be nice to see one more move towards the sort of the high end of rates, right? Maybe we see persistent inflation and we see the long end continue to creep up a little bit more. But at a certain point, you know, this is going to be, I think this is going to be a really strong performing asset. You know, we had a really weak 60, year for the 60/40 portfolio. And so, and for bonds in particular. So there's got to be some mean reversion, you would think. And it's something that, even though we love talking stocks, this is, there's a point where this obviously can't be ignored, and you have to just move your money wherever, whatever the chart is telling you. So this is, one that we want to keep highlighting. All right, I think that's the last slide we had there. John, are you here?
I'm here, Wes. Thanks a lot.
Excellent. Okay. Hey, Roy, did you want to take a 5-minute break just before John gets started right at 8 o'clock?
Let's do that. Let's take just a 5-minute break so we can wet our whistle, grab some water, use the restroom. We'll be back in 5 minutes and hear from the great John Roach.
Well, that's a nice intro. Thanks.
Are we starting?
We're about to get ready here.
And Roy, is this meeting recorded and would this recording be available?
It is. Yes, Ashish.
Thank you, sir.
You're
Yeah,
welcome.
and just while we are mentioning it, I did put, I am putting these up on YouTube now just because it's the best, way to distribute it. So I guess I can just drop that link to the channel. We're not trying to become YouTubers by any means, but it's a good tool.
And when we get started here, let's make sure that everyone can see John's slides. I'm not sure if I can see them or not on my
Yeah,
screen.
they're not up yet, right, John?
Not yet, Wes. You tell
All
me
right.
when, I'll share the screen.
We're ready.
Okay. All right, so I'm gonna say share screen and. Okay, let me know if you could see him.
Yes.
Okay,
And I don't, so I wonder why. Hold on one second.
okay, all
Okay, I do now. Doing
right.
the background. Again, we wanted to welcome John for doing this for us. He actually hopped off of a plane in Boston at 6 p.m. To make our meeting tonight at 8. We're thrilled to have him join us. It's the first guest speaker we've had in 4 years. So, John, you're at the top of the list.
Thank
As
you.
far as we're
Very much.
concerned.
Thank you. Good to be with you, Roy. Good to be with you, Wes. Thanks a lot for having me tonight.
Absolutely.
Okay, so do you just want me to jump into the slides and maybe it'll engender some sort of Q&A or some questions, and then perhaps we can all talk about it. And Roy and Wes, if you see something that I don't, because I'm certain I don't see everything, please jump in and point me in the direction if you think that something else that you'd like to talk about.
Sure. You may want to. Are you seeing the full screen, the slide deck, full screen, guys? The members. I'm just seeing. I'm seeing thumbnails of your
Yeah,
slides.
the file, right? Like you haven't hit view full or whatever. Start show.
So let me
If you'll
see
hit
here.
slideshow at the top, probably slideshow, and then start from the beginning, probably.
Okay, so I'm going to stop the share and then start it all over again.
Okay.
Share screen. This here. Share. And at the top of the screen, it's mute, stop video, participants, chat, new share, pause share, annotate, apps, or more.
Okay, we're talking about the the PowerPoint window itself, and then the
John, it's at the bottom right corner. You have the slideshow. Yeah, there you go. Around there, further down. Next.
Perfect.
Yeah, there you go.
There you go. Perfect.
There you go.
Thanks. Thank you for whoever helped out. Thanks. You could tell me I'm a Luddite with this stuff. So thank you, everybody, for your patience.
You're welcome, sir.
Okay, so this is a chart pack that I used. I just used it in Boston, and I used it last week in a webinar. All the charts are updated. I have to start out my presentations with, and Wes will confirm this because we worked together for a while. Well, I have to have some sort of a hook or some sort of a laugh because the business can be dry. And so I use the softball line here because a league that I'm familiar with in Westchester County has raised their prices for the 2023 season versus 2022 by 41%. So I was just wondering if the CPI services makes it into the CPI. If softball services makes it into the CPI.
It should.
It should. Okay, so this is not my graphic, but I use it all the time in meetings. I just want to know where market sentiment is. I believe we've gone firmly from denial to hope. I don't think that we've achieved or we've gone through what is fear, desperation, panic, capitulation, despondency, or depression. We've gone from denial with respect to that there would be high inflation and that the Fed would raise rates into hope that the Fed will stop raising rates. I've had a lot of institutional meetings. I had 6 meetings today, one last night in Boston, and I've had other meetings and conversations, so far in this new year, as well as in late 22. And my humble opinion is that the only narrative out there at present is that the Fed will stop raising rates. There's no other narrative. There's no other narrative with respect to industrials being in a new cycle. There's no other narrative with respect to wanting to buy basic materials because prices will remain high. There's no other narrative with respect to technology stocks being cheap and we should buy them. And there's going to be a new software cycle. There's no other narrative as far as I can tell. It's really just with respect to the Fed. And so I really think that the Fed has made themselves way too important. They're the game. And I think in a way to avoid the constant back and forth from Fed speakers is to try to pay attention to trend, because I think sometimes we can get stopped out on a daily basis. But if we pay attention to trend, we're likely to stay in for a more important move. So I like to ask questions when I make my presentations, and the chart in the top panel is the equity market capitalization in the US. This fifth episode, we're down more than $14 trillion and 27%. It's the most lost on an absolute basis as far back as I have the data. It's the second biggest percentage loss. The first biggest percentage loss was the 07-08 decline. The prior declines were met with the Fed coming to the rescue. This decline has not yet been met with the Fed coming to the rescue. But with this being down 27%, $14 trillion, and the bond market down a lot, and crypto down almost 80% using Bitcoin from peak to recent trough, that's a lot of market cap or wealth destroyed. And so I wonder, why haven't people taken it more serious? So I asked the question in the right-hand panel. The Joker from the Dark Knight would ask, why so serious? And I thought if he were a market analyst at this point, he might ask, why so unconcerned? I like this little cartoon, which comes from the New Yorker magazine. It shows Jay Powell in there juxtaposed. And he asks, sure, we destroyed the global economy, but for a beautiful moment in time, we tried to get inflation back to 2%. I think that's kind of the way we should view the Fed. We should view them cynically, because they really don't know what goes on the ground. You can't know what goes on the ground when you sit in the backseat of a Fed-driven town car. So I'm very fond of this graphic. I had the very good luck to spend 4 years at Soros Fund Management. I don't know Mr. Soros, but I worked for his son, Robert, as well as Scott Bessent over those 4 years. But George Soros is famous for saying, just give me enough information. This graphic bears his point out. It was a study conducted in 1974 by a guy named Paul Slovic. And he decided to work with a number of horse handicappers, and he did a study. And the first part of the study was he gave them 0 data points. Their accuracy in picking winners in horse races was 10%. Their confidence rate was the same, 10%. He then increased the data points to 5. Their accuracy was up 70%, 10 to 17%. Their confidence level soared even more, 10 to 19%. Then he gave them 40 data points. Their accuracy did not increase, but their confidence level soared again. And this study made its way to the CIA website. And I happened to be once in a meeting with a former director of the CIA. His name was George Tenet. And I should have asked him the following question. I should have said to him, Mr. Tenet, did you learn all you needed to learn about running the CIA when you worked in your family's diner in Queens, New York? But I didn't ask him that question. I asked him the following question. As the director of the CIA, how much information did you need in order to make a decision? And he said, that's a pretty good question. He said, if I knew it was going to take me 7 years to get 100% of the information, or I was going to get 70% of the information in 2 years, I would make the decision in 2 years. And I thought what the former director of the CIA, George Tenet, said, what Paul Slovic proved, and what George Soros said all kind of fit neatly in a row. And to use Mr. Soros's line, just give me enough information. I think us as market participants or analysts or observers always look for the most information we can find. And I believe that we don't need all that information. I believe we only need a few pieces of information, because when we get more information, it just confirms our already existing biases. And sometimes looking for all the information prevents us from acting. All of this sort of feeds into a line made famous by Paul Jones, who once said, price turns, and then a narrative follows. The narrative, of course, comes after the price turns because we understand why the price turned. But if your indicators are good enough, maybe that price turn is all the information you'll need. I'm also a fan of Marty Zweig's rules. Marty Zweig was a famous investor. You could please read his bio on Wikipedia, but he had these 17 rules. I've highlighted in red or circled in red what I think is the most important rule. The trend is your friend, don't fight the tape. He said to me, the tape is the final arbiter of any investment decision. I have a cardinal rule, never fight the tape. My friend Stan Weinstein, who once published the Professional Tape Reader, who now publishes Global Trend Alert, has been using the line, the tape tells all, for as long as he's been running his service. I also like number 7 for Marty Zweig, which is every indicator eventually bites the dust. Sometimes it's because too many of us are looking at the exact same indicator. Okay, so I know that Roy and Wes likely have covered this. I didn't come in until maybe a few minutes before Wes went to break, but I do appreciate Wes using Brobdingnagian in a very proper manner. So thank you, Wes. So my colleague, Dennis DeBuscher, whose father is a Hall of Fame basketball player who once played for the New York Knicks, Dave DeBuscher, Dennis chatted with Larry Summers on July 1st of 2022. And Dennis gets the Emmy for asking or getting Dr. Summers to answer the question as follows. Dennis asked him if he thought the Fed would stop raising rates as the economy slows. And Professor Summers said, as a person with responsibility, we want to make sure we don't make the same mistakes. We want to make new ones. So I think the Fed's making a new mistake, and I'll show you why in a second. I'll also preface it by saying I'm not an economist, but Larry Summers also said soft landings don't happen. Okay, I'm going to pass the S&P here because I don't think it's particularly instructive that I can add anything of greater import than Roy and Wes already did. We're all paying close attention to the S&P, and forgive me for being a little bit of a wise guy here, but I don't think that's the game. I think the game is to try to find sectors and stocks that will do better or are improving at a rate greater than the S&P 500. Roy and Wes would term that relative strength, and so I would call it the same thing. But I'm just going to show you this long-term chart for the S&P, which is a monthly, which shows you this is an arithmetic MACD at the bottom panel. We're still not oversold on a MACD basis. And I know it's arithmetic, so we're coming off of higher numbers than we did in the early part of the 2000s. And then in the latter part of the early 2000s, the first decade, we're coming off of higher numbers. So it may take us longer to get to oversold, but we're not oversold yet. And we're still beneath a downward sloping 12-month moving average. Same is kind of true for NASDAQ. I do think it's important to point out the following. I don't know if Roy and Wes went through this because, again, I wasn't on for the early part of their presentation, but I'm going to show you my version of cumulative breadth. I'm guessing that Roy and Wes both went through this. So in the early part of the bear market in 2022, the broader market corrected very sharply. And then in the latter part of 2022, big cap tech came under extreme pressure. But cumulative breadth, which is the daily difference between advancing stocks and declining stocks, cumulated or accumulated over time, has actually been going sideways now since May. So the internals are trying to firm up. They really are trying to firm up. And breadth has made a higher low of late relative to where it was in October. And what is most helpful or telling for me is that the prior rally to the little action we're seeing of late was led by what I call non-growth. In my parlance, that is basics, energy, financials, and industrials. It was not led by tech and consumer discretionary. I do believe if we start a new advance, that it will not be led by the former leaders, tech and consumer discretionary. I believe that the leadership will come from other sectors. To date, and I think Roy and Wes would help to confirm this, we've only seen relative leadership. Relative leadership has been in the non-growth or value side. And I call it non-growth because I didn't want to have to define value as a technical guy, but I can identify non-growth by just looking at it. So breadth is improving. That's a plus. Okay, this chart shows on the blue line, the Fed funds rate, and the black line is the S&P 500. The percentages in the chart show what has happened historically to the S&P after the Fed cut rates. Now, of course, the Fed cuts rates because they know we're going into a recession. And you can see what the numbers look like after the Fed has cut rates. The pink vertical bars are the recessionary periods. So it's not a great history to be betting on the Fed cutting rates here and that the equity market will receive this great, palliative cure. I think it's another reason just to be cautious because
John.
the history says we should be cautious. Yes, Roy.
John, let me ask you, wouldn't you say that the narrative on CNBC and on financial channels right now, the narrative is as soon as the Fed pivots and cuts rates, the markets can take off? And that just seems to be counterintuitive from what we see from the data.
That's right. I agree with what you just said. I couldn't have said it better. That's what that's the way it works. Correct. Now I'm agnostic enough to know that it doesn't have to be the same this time because these cycles are different. There are fewer active managers now than there were in prior cycles. There's more pod shops. There's more algo trading. There is certainly the ubiquity of ETFs. So people can get long in an instant. So it may not be the same, but I'm colored by that I should know the history here. And Michael Crichton, the famous author, once said, if you don't know history, it's like a leaf not knowing it's part of a tree. I want to be aware of the history.
Very good.
Thank you. This is also another chart showing the Fed funds in blue and the 2-year Treasury yield in black. We all know that the Fed is likely to raise rates again. That's kind of the thought here. In fact, there is talk now that they will get to somewhere near 6%. Not my talk, but I'm sure you guys have heard it as well as I have. The history suggests that when the 2-year Treasury yield falls below the Fed funds rate, that the Fed is close to ending its rate hiking cycle. That's what the history shows. Bill Dudley, former head of the New York Fed, should know this, but he wrote an article not so long ago where he kind of glossed over this. The Fed always follows the 2-year, always. You can see in this chart, there are 2 months, 3 months, 5 months, 8 months, etc. Those were the lags for the Fed to follow the 2-year as the 2-year advanced. And I used the line last year and late into 2021 that the Fed was like a bunch of Birkenstock playing, Chablis sipping people in the backyard while the 2-year was doing its best impression of Usain Bolt. Finally, the Fed has caught up because the 2-year is suggesting that there will be a slowdown. This is the 2-year on a weekly basis, going back to the early part of the 2000s. The middle panel is a MACD, and the bottom panel is an RSI. You could see that momentum has crested and rolled for both indicators. I think the 2-year yield can get back to 3%. And this is the entire yield curve from 12 months to 30 years. The black line is the 12-month Treasury yield, which at about 4.6%, 4.5%, that's good money. But the rest of the curve is coming off of a lower high vis-a-vis the autumn highs. So you have momentum deteriorating, and we're making lower highs on the tenors from 2 through 30. It suggests to me that the next move lower is the next move for yields is lower. That's what it's suggesting. I think the TLT is likely to be a good purchase on pullbacks. I wanted to show what a real bubble popping looks like. This is the global aggregate negative yielding debt. You can see that it developed a head and shoulders top. It peaked at 18.4 trillion, and now it's down 99% from its peak. That's a bubble popped. When bubbles pop, the items go down 80 to 90%. If they go down 70%, that's a lot, but that's not a bubble popped. History shows that bubbles pop when items go down 80 to 90%. This chart shows what the top 5 weighted stocks in blue and the top 10 weighted stocks in pink weigh in the S&P 500. Both the top 5 and the top 10 are at their lowest levels since before year-end 2020. So these stocks are deteriorating on a relative market cap basis in the S&P 500. I think that their importance will continue to wane. So I want to be underweight what is the big 5 or certainly the big 10 relative to the S&P. And this is a broader look. This is the S&P 100, the OEX relative to the S&P 500, the SPX. And as the line deteriorates, the S&P 500 outperforms. And it wouldn't be a stretch, I don't believe, given the long-term construction here going back to the mid-70s, to see this indicator or line relative ratio move to a new low beneath its lows from 2013 through 2019. So I'm going to go through a few other relative charts that I think are important. This is the Dow relative to NASDAQ. I believe this is the 4th turning. I'm using that title, which comes from a book from 1996 written by Neil Howe and William Strauss. I recommend the book. This turn is about 13 months long, maybe now 14 months long. It's up about 40+%. It is still shy of the prior 3 turnings. Now, I know that we can't admit this into stats class because there's not enough evidence, but we can certainly admit it into portfolio management class. And I think it's important to pay attention to. This is another way to think about non-growth doing better relative to growth, or value doing better relative to growth. So this is the Dow versus NASDAQ. I'm inverting the relationship here, and I'm showing the NASDAQ versus the S&P. This is in force now for 23 months. The prior 3 cycles lasted 50 months, 89 months, and 30 months. This is also an important relative ratio that I think we as investors should really pay attention to. It kind of fits in with the relative ratios we just reviewed. This shows the S&P 500 in the numerator relative to the MSCI World X the US. Now, I did catch Wes talking about that at the end of his chart packet. I agree with him. It wasn't canned. He didn't put it in there for me, and I didn't put this in here for him. We happened upon these separately. But you could see that this would be the 3rd cycle since the early 70s where the S&P had peaked, or the US stock market had peaked relative to the world X the US. And then in the bottom panel, I'm using a 12-month rate of change based on the top panel, and it's moved to a 12-year low. There's some symmetry there. There's a 12-month rate of change moving to a 12-year low. So the momentum looks like it's really coming out in favor of the denominator, or the MSCI World X the US. This is the EEM, the MSCI Emerging Markets ETF. I think it looks pretty good. The bottom panel is the relative. If this turn is real, this is really at the stage, I said it's in the zygote stage, or it may be when the singer sings the national anthem before a football game or a baseball game. It's still in the very early stages, but I think this EEM has made higher lows since 08-09, tremendously oversold, got to that trend line. I don't know, maybe 50 is a reasonable target. And I'll tell you something about how I see my job. And I don't know that anybody else sees their job who does technicals like I do, but I think my job is to hit a home run. My job's not to hit singles. The reason my job is to hit a home run is because I believe I'm a trender, not a trader. I don't think I'm a good enough trader, but I think I'm a pretty good trender. And so I try to think a little bit longer term. And I think outsized moves happen more often than we want to believe they do. I'm also a believer that there's no such thing as reversion to the mean. Nobody ever bats the average, their lifetime average, on the back of their baseball card. They hit above and below their average. That's how they get their average. So I believe the business is a reversion beyond the mean business, not a reversion to the mean business. So if anybody ever says it's a reversion to the mean, your job is to ask them over what time frame. Because if they don't give you a time frame, you can't really identify what the reversion to the mean is. I always want to think about the reversion beyond the mean. I'm going to show you a longer term chart, which would give you that idea. This is the FXI in the top panel with the 12-month moving average in green, FXI relative to EEM in the middle, and the FXI relative to the S&P at the bottom. I don't see why this can't get to 40. 40 would really be kind of the breakdown level from mid to late 2021. I don't see why it can't get there. It would fit in with the EEM as well. This is the Hang Seng Index, which has really done better than China. My first target on the bounce was 20,000, and then I thought you could see it at the top of the page here in the orange. I think it can get higher, and the 50% retracement of the 53% bear market would get it back to 23,000. I think it can do it. I think China is a particularly contrary investment idea here because the Chinese have had a very difficult time with COVID. I'm not going to comment on the Chinese. I'm not going to comment on COVID. But to me, they're improving despite the fact that they're still going through tremendous issues. The contrary idea is that the price is telling us something about either Hong Kong doing much better or China doing much better. And then I want to go through what I think was my most difficult call in 2022. I thought Europe was going to be much worse than it was. And for that, that's a mea culpa for me. I should have done a better job there. However, in retrospect, I think the reason that Europe did not do worse was because they didn't have a lot of growth stocks. Most of the growth stocks are in the US. Most of tech is in the US. Most of Europe is made up of what would be called value stocks. Their indexes are heavily weighted to financials, particularly banks. Miners are domiciled in Europe. There's an awful lot of cyclical stocks in Europe as well. So I thought it was going to be worse. It was not. And while it did get a little bit harrowing, the rebound has been very strong. So this is a big base. And thank you, Wes, again, for using Brobdingnagian. But Europe is holding up on top of, or held really what was the top of the base that was in force for 20 years. And you could see how the first part of the range from early 2000 through what was 2014 was very wide swinging. But from 2014 through 2020, it was narrowed by a lot. That is also kind of a message. And now we're above that. So I want to give Europe a little bit more credit than I initially did when I talked about it a lot in early 2022. Okay, so I'm going to go over just a few other charts here, and then I'm going to turn it back to Wes and Roy, and hopefully they'll push me forward or ask some other questions. And before I do that, I just want to say thanks for allowing me to be with you. So I think this is a pretty good idea for early 2023. I'm going to preface it by saying the following. I like to make my own indexes. I make my own indexes that are not represented by the S&P or ETFs. Sometimes I double up with ETFs, but I've made my own fertilizers index, my own uranium index, my own iron ore index, et cetera, because I want to be able to present this in index form and show what they're doing on an absolute basis combined as a unit and on a relative basis combined versus a benchmark index. So I made this index that I call, it's rocks. And I prefaced it in early December by saying rocks are greater than paper. And then I did it right after that by using Michael Jackson's song, Rock With You. And then quite recently, pardon me, I did it with Rock the Casbah by The Clash. Maybe I'll choose Rock and Roll High School by the Ramones. There are any number of songs to go with this. There are 5 stocks in this index. Anglo-American, BHP, which is formerly known as Billiton, Fortescue Metals, Rio Tinto, and Vale. Vale, of course, trades in the US, and the other 4 trade in the US as ADRs. The 4 stocks, not Vale, have very chunky yields. Chunky enough that the hot dog eating champion Joey Chestnut may choke on it. That's how chunky yields are. So this index on a combined basis has completed an 8-year relative big base. I should have called it Brobdingnagian. I choked on that one, but it's broken out of a big base versus the S&P 500. I think that's a big plus. It's broken out of a big base relative to NASDAQ, another big plus. It's broken out of a bigger base relative to the bank index. So this would be rocks over paper. And then here it is relative to another index I made called the Big Five: Apple, Amazon, Google, Microsoft, and Tesla. So there's some nice relative action for this compilation of these 5 stocks. I realize it's only 5 stocks, but there are not a lot of public iron ore companies. And this is what the group looks like on an absolute basis in the top panel. I worked at Lehman Brothers in the mid-90s with a great guy by the name of Steve Shobin, terrific technical analyst and an even better person, and the quippiest guy you've ever met in your life. And he was very fond of the pattern that he called a base on a base. And that's what we have here. We have a base for these stocks going back to 2021, sitting on top of what was formerly an 8.5-year Brobdingnagian base. And Brobdingnag comes from Gulliver's Travels. It was a word invented by the author Jonathan Swift. And we know that Gulliver traveled to the land of the Lilliputians, which were the little people. He also traveled to the land of the Brobdingnags. They were the giants, and I just made it into an adjective. And the bottom panel is just a repeat of what we saw a few slides ago for the iron ore rocks index versus the S&P. And so I took all 5 of those stocks and I indexed them to 100 as of December 31st, 2007. So you could see there that there's the color scale. Rio's in black, Vale's in blue, Billiton's in green, Anglo's in orange, and Fortescue is in pink. Fortescue, Billiton, BHP, and Rio Tinto, in my opinion, are the leaders of this group because they are all above their highs at the last commodity cycle peak. This is BHP. So you could see here, it's above, slightly above where it was in 2008. This pays a near 11% dividend in the ADR. Now it's up a little bit since I put that in there, so maybe it's slightly under 11%. But this is a big base. And I'll use a phrase and say, this is my raison d'etre. I'm really am trying to find big bases. Big bases, upon their breakout, are usually, because breakouts fail sometimes, so it's not always the case, are usually the manifestation of a fundamental story. A stock doesn't break out and become manifest because of a technical story. The story is manifested because of a fundamental story. Now, I'm going to leave it to people out there who are smarter on this than I am. Is it because China is going to open up? Is it because China is going to stimulate? Is it because there's a paucity of supply for these stocks and demand is just going to be stronger than supply? It's immaterial to me at this point what the narrative is. I'm just identifying that this suggests that there will be a narrative to come. Also, I'm very fond of not looking around too many corners. If this fails, I want to be out of it because it fails, because the price failed. I don't want to keep myself in if the price fails because I have embraced a narrative that I didn't start with. So I'm going to dance with the girl I brought, not leave her and dance with somebody else. So it may be a weak argument in my part, but it's the only argument I have. I'd rather be wrong for my reason than be wrong for somebody else's reason. So this is BHP. This is Fortescue. And if you went all the way back to when Fortescue became public, Fortescue is actually the best long-term performer of all of the iron ore stocks. So if you index them to 100, let's say going back to 2004, Fortescue really is the best one, perhaps because it came from such a low level to begin with. So its percentage increase would have been so much greater. But this is a very attractive setup. And again, the ADR pays a very chunky dividend. And here's Rio Tinto. Rio Tinto is probably a little bit better than Anglo and probably a little bit better than Fortescue. This is really a nice setup here. Now, Rio Tinto tried in 21, and I'll tell you, I was there for that try, and it came back in, and then it held the upward sloping trend line. And then I was there again to try it in early 2022, and it came back in again, and it held that upward sloping trend line. So I'm telling you that these things don't always work as we want them to work, as I want them to work, but it didn't fail. That was kind of an important sign. Maybe it needed more time to present its case or to build its case to prepare for the breakout. Maybe that's what it was doing. Oh, and then I'm going to leave it on this one because this is my big 5 index, and I'm going to turn it back to Roy and Wes and tell them thank you very much for allowing me to be here. But this is Apple, Amazon, Google, Microsoft, and Tesla, created as an index, price weighted. I don't market cap weight. I don't equal weight. I want them to be price weighted. You get the clues just as nicely from a price weighted index. The top panel is the absolute version of this compilation. The middle panel is the weekly MACD. And the bottom panel, which is especially important for index-related investors, is the group versus the S&P 500. That's a big top relative to the S&P. If all you had was that bottom panel, I think it's very difficult to be a buyer of these stocks. So I'm going to turn it back to Roy and Wes. Thank you very much for your time. Thank you for the opportunity to be with you. I consider you friends, and thank you very much. My pleasure.
Thank you, John. That was terrific. We appreciate having you on today. We'll open for questions at this particular time. And John, if you'll stop sharing your screen, or if I can do that.
I can do it.
Okay.
Okay, back to you.
Let me, what I'll do is I'll pull up MarketSmith also. So we'll take a look at some individual stocks if we'd like to do that. But let's open the floor to questions for Wes, John, or myself. So guys, go ahead.
Roy West Group, it's Michael Kleiber.
Hey, Michael, how are you? Glad to have you on today.
Thanks. Any thoughts on gold, which seems to be making a move for the next quarter or two?
Gold is definitely in a short-term uptrend. And, if you take a look at John Roach's work, it's setting up with the Brobdingnagian base. When you look at the chart on the monthly, so it's possible that we have embarked on a new uptrend. We'll see what happens here, but I would definitely say we're in a new uptrend. And if we take out the highs, I could see gold. I could see the GLD going to 300 from here.
Good, thanks.
And let me point out one other thing, guys. Michael Kleiber pointed something out to us a year ago when he got in early in the energy stocks. And we know that the energy stocks led the market and last year in 2022. It's possible that these iron ore stocks and basic materials, metals, they could lead the market from here as well. And we're very, very early in the rotation as well.
One question regarding the rocks. Are there any concerns about the yield being so high?
John, go ahead and answer that.
In that they may cut their dividends because the yield is too high? They can't make their payments?
In part, but also I think when I've played high yield in stocks, they're high for a reason, because the stocks obviously haven't performed so well. But I think it was Peter Lynch who says he never touches anything with a yield greater than 5%. They're just too risky.
It's fine if you don't want to buy them because the yields are too high. I'm certainly not suggesting that anybody buy them.
Mhm.
I haven't considered that the yield might be too high. In fact, they have actually performed, not performed. Remember, they went sideways versus the S&P 500 for 8 years. So it was an S&P return. In fact, probably a better return because the yields are bigger on an 8-year basis. So it's not that they haven't performed, they have performed. But if it's up to you. There's no suggestion here that anybody buy anything. I'm merely pointing out their price action. So that was Peter's rule. He was a tremendous investor. It's not crazy. If it's unpalatable to some, it doesn't make a difference to me.
Okay, thanks.
John, can you talk about copper?
Okay, I'll do my best. I think copper is improving. It is certainly not, in my opinion, as let's say a healthy a chart as I would prefer, but there's no doubt it's improving. Its corrective phase in 2022 was particularly strong. It was a tremendous correction from, let's call it, the spring of 2022 into the late summer. It's come back. I think it will work higher, but I think I can do a better job with iron ore than I can with copper. However, I am enthusiastic that gold, silver, copper, and iron ore are improving all at the same time. I didn't say it, but I should have said it. I think metals will be better in 2023 than energy commodities are in 2023. Energy commodities were much better than metals in 2022. I think metals commodities will be better than energy commodities in 2023. I wish copper had a different setup so I could be involved with it. I traditionally don't have much luck with this kind of setup, but I am glad that it is improving because it makes the case for the metals, I believe, a little bit more important.
John, what's your opinion on gold versus silver? Do you prefer one versus the other?
I don't prefer one versus the other here. I do know that when there is a gold bull market, there is a silver bull market. And I do know that where there is a gold bull market, there is usually a bigger percentage increase for silver. I am just glad that they are improving at the same time. So I am glad for that reason, but I don't think it is necessary, Roy, for me to make a distinction between one or the other. I think you'll get more gearing, or there will be greater percentage returns from silver relative to gold, but they tend to fit hand in glove when there's a bull market in gold.
Great, thanks.
Thank you.
John, I had a question. One slide in particular that you had there, when the Fed finally did cut rates, the
Yes.
actual the equities fell apart in prior recessions. I found that quite interesting. Would that mean that I guess bonds would be a good purchase at this stage, if something like that if we get in bonds right now? I mean,
well, I'm not an economist. I'm not predicting a recession. What I am telling you is that the history shows that when the 2-year Treasury yield moves below the Fed funds rate, that the Fed is near the end of its rate rising cycle. So that would be a pretty good sign for bonds. So that part I agree with. I don't know if there will be a recession. I don't have any call on that or any opinion. I don't do any economic work. But the history also suggests that when the Fed does cut the Fed funds rate, that it has been historically followed by a recession. So the history tells us to think in that way, but it talks in probabilities, not in certainties.
thank you.
Thank you.
This is George in LA. Regarding when the Fed pivots, that is not pauses, but actually starts cutting interest rates, what is the time difference between when they start and when we bottom, generally speaking?
I don't have an answer for you, George, on the time frame. I do know, and you saw what the chart looked like, that there are varying percentage declines. One was 40%, one was 17%. So there's an important decline to follow. I don't know how long that time frame will last. I don't know the answer to that question.
Thank you.
George, just for historical purposes, let me just point this out. And this is just, we've covered this before on some slides before in prior months. So, the National Bureau of Economic Research they dictate whether or not we are officially in a recession or not. Right now, based on their information, the economy is not broadly weakened enough for that to happen. But our data shows that the market, and this is some work from Ned Davis Research, that the market typically bottoms halfway into the recession. So, and that it also suggests, based on the yield curve inversion, that we most certainly are going to be in a recession, whether or not it's slight or a soft landing or a hard landing will be predicated based on how long the Fed keeps interest rates at a high level and to what degree, how high they are, what what the terminal rate will be. But typically the market bottoms halfway into the recession. So that anecdotal information suggests that it fits with the narrative that the market might go lower because of the valuation basis, and certainly because we're not in a recession yet, according to the National Bureau of Economic Research. So that's just some information that you can contemplate.
Roy, I got a question on that. It's Larry.
Hey, Larry.
We had 2 quarters of negative GDP where everybody was saying we're already in this recession. How does that play with what's being said now that we're not in a recession and maybe haven't been? I'm thinking that just like that 1.4 put to call ratio,
Yeah.
there's nothing random about any of our statistics in the stock market. We need to listen to what it's telling us. We just may not know what it's saying, but there's meaning there.
Yeah, that's a good point. And remember, and I think this, from a political standpoint, it was plausible that we had those 2 negative quarters of negative GDP, that in prior cases, that's all that we would need to be officially termed that we're in a recession. But politically, it wasn't expedient. So, so they changed the definition. But now, I think you really need to look at non-farm payroll employment, real personal consumption indicators, industrial production, wholesale retail sales, personal income. A lot of those are declining, but they're not at a degree yet where the National Bureau of Economic Research would say that we're in a recession. But certainly from a rotational standpoint, we have many parts of the economy that are slowing down currently. And, so the weakness in the economy is obvious. And, also just remember that we still have that lag indicator. There's always that lag from where interest rates until interest rates impact the entire economy. And we haven't seen that yet. That's coming, I believe.
All right. So that was just the show before the show.
Yes.
All right. I'm just wondering if they're going to come back in the future and say, well, there was the recession, or they're going to come up with some narrative that fits the data the way they want it to.
Well, this has been it's been an unusual bear market because it's unprecedented. We've never, I don't, maybe John can attest to this. I've never been in a situation where we had such quantitative easing and such a rise in the balance sheet and the money supply. Never seen anything like that, and we've never seen anything like that, and it's created this inflationary backstory. And we really just don't know how difficult it's going to be to squash inflation and get it down to that mandate of 2%. Yes, the bullish pundits out there might say that the Fed is just talking out of their mouth, and they're going to, we get to 3 to 4%, and then they're going to change the rhetoric, and they're going to say that's enough. But I believe what Powell says, and I believe what Larry Summers was saying, and I think the Fed is going to get it right, and for them to get it right and to quash it, they're going to have to really put the brakes on the economy. And Powell has clearly said that the unemployment rate needs to rise. We were at all-time lows. It needs to rise from 3.5 to 5%. And if that in fact happens, there's going to be a lot of things in the economy that are going to break, in the next, 3 to 6 months.
Thank you.
Hey, John, this is Amol Desai. Thanks for the wonderful presentation.
Thank you.
I had a question. I was looking at the 70s because there are definitely lots of parallels, 70s and the 40s. But when you think about 73, 74, brutal bear market, but the bear market bottomed very exactly as rates peaked. And then the market made a pretty ferocious advance over the next for a long period of time. And earnings, if you look, bottomed much later on, maybe later part of 75. So one of the arguments today is, yeah, P's have contracted, but of course, there's a much bigger earnings contraction coming, and therefore the market has to go lower. So history doesn't sort of, or at least that one episode does not jive with what the narrative is today. How do you think about that? How do you think about maybe even the 40s and the 70s as you think about the environment today and what the charts are telling you?
Okay, so I happen to agree with you that what you've just described is kind of, I'll put it in small quotations, small letters, a consensus viewpoint is that there's still an earnings decline to happen. So stocks have not yet fully priced in the earnings decline. So I think that it's becoming a bit of a consensus viewpoint that stocks still have to deal with their earnings decline. And to your point, it would not surprise me, in addition, if prices will have already discounted such a situation, number one. Number two is, the last time inflation was this high was in the period that you mentioned during the 70s. And it took the Fed 9 years to get the inflation genie back in the bottle. I believe inflation will be sticky. I believe much of the price increases we've seen are now embedded. There's no way any of us is paying less for a slice of pizza than we did pay a year ago or 2 years ago. It's not happening anymore. Those prices are now embedded. In fact, in LaGuardia Airport, in the Delta terminal to go to Boston, it was $20 for a hamburger.
Wow.
That's $20 for a hamburger. I bought 6 cookies as a snack on the way home. It was over $6 for 6 small cookies in the terminal in Boston to come home. The prices are, in my opinion, embedded. So I think it is likely that equities will remain challenged, but it does intrigue me that you have identified what I think is likely a consensus viewpoint where stocks will likely be ahead of the case. It seems to me that all of this is kind of already priced in. Most of the investors I met with were concerned to negative, and I would say that cash levels are pretty high here as well. So I think a lot of what you're saying is right with respect to the 70s. But in the you stayed in a 16-year range and did not really break out until the early 80s. So it might be that this is the 5th cycle of sideways action, which would be symmetrical with 5 prior, what I would call secular uptrends. So maybe we are going to be in this 5th period for a little bit longer, but it might be that we do get a rally and it goes higher than most believe.
Yeah, because I think there's also the second consensus opinion is if I read every strategist is, the first half is down, you get capitulation, and then the second half is up. And that's just too cute. That's just not how the pain trade to me is that rates go down. And as you think about, we all agree that prices will not come down. What we know is from a stock standpoint, or markets look at year-on-year numbers when it comes to inflation, right? So we are not looking at absolute decrease in prices. We're just looking at what is the rate of change.
Slowing in the rate of change.
And when you look at the comparison starting in February to June, the inflation comparisons are incredibly difficult because of what happened with the war, the spike in energy, and pretty much every price literally took off. So you're going to see some massive declines. Not only are you seeing month-on-month declines in the coming, I think the consensus for negative 0.1. So you're starting to see that. Those will be magnified as you go into February, March, April, May. So the contra in me says this is way too cute, the way everything is set up. And I think the pain trade is mostly higher. And then when I think about the 70s parallel, that markets bottomed literally exactly the point where rates peaked. I think we're all generally agreeing that rates have kind of peaked and we'll see a drawdown. So there's quite a possibility, and that's maybe you should, what you think, that maybe there's more pain in latter part of 23 or maybe even 2024, and 23 is almost sort of this pain trade higher because of the way things are set up and how consensus is set up.
Roy, do you want to take that?
No.
Okay. Okay, so I do think it's too cute that the strategists are in great agreement. So I agree with you there. I do think, however, from where I sit, that it's way too difficult for me to anticipate when the decline will occur. Will it occur in the latter part of 23, or will it occur in the latter part or in the early part of 24? I tend not to approach my job in that fashion. I do approach it in the following fashion. If I see something that I think has the chance to rally and I want to be involved, then I make that suggestion and I use a stop, which will take me out. I do not try to make my decisions based on if there will be a decline in the latter part of 23 or in the early part of 24. I think it's too hard for me to do it like that. I try to create small equations when I'm trying to think about a potential investment idea. I think the more inputs to a potential equation make it all too difficult to be solved. But your point about the strategists aligning is a very important observation. So I think that's key here. If you couple that with your point that you think inflation will be lower and perhaps cash levels are high, then I think we can have an important rally. I think that's probably an easier takeaway for me to make rather than creating some longer term what if statement.
You know, a great takeaway that I have, and I'll just segue based on John's comment, is that certainly you definitely see the bears consensus view right now. I mean, Mike Wilson was on TV today and he was given his consensus view where he's looking for potentially earnings going from 230 to 180 in 2023. So there's a consensus view, but the consensus view also is that earnings are going to be up 5.7% for 2023. And so that's also a consensus view. What makes this extremely difficult is we're seeing some very valid and better breadth participation, the percentage of stocks above their moving averages in the NASDAQ, and particularly in the S&P and in the Dow. That's suggesting stronger momentum. So the averages could go lower and not, while most stocks have already bottomed. I mean, even if the market goes to 3,000 to 3,300 on the indexes, I think looking back, you're going to see a positive divergence with the percentage of stocks above their moving averages on the pullback, if that pullback occurs. And John had the nifty chart where we just skipped the fear, despair, desperation,
despondency, right? Desperation, right?
And so this, in our experience, we've always had that. You know, in prior bear markets, this would be unusual if we avoid that this time. And so that remains to be seen what's going to happen. Again, that's just anecdotal information. You have to follow the trend, not the narrative when all is said and done.
No, I appreciate it. Great presentation.
Thank you.
Thank you very much.
Thank you for the question. Thank you.
Thank you.
Thank you.
Hey, Roy, I've got a question for John. Looking at your iron ore index, if we go into a recession, and how does that play into your index? It looks like to me the demand for iron ore and the other things would go down rather than go up.
Okay, so I'm going to give you the same answer I've tried to give some of the other questioners. I don't try to answer that question. I can't solve for it. I can't solve for if we go into a recession. I can't solve for it. The stocks suggest that there's something else going on that we're not solving for.
Okay.
I just can't answer it because I don't have the inputs to answer it.
Right.
And if that's the case, and I promise this is not being a wise guy, then we shouldn't be buying anything because most stocks go down in a recession.
Right.
I don't know that my stock picking acumen would be good enough to find the handful of winners that would do best or better in a recessionary environment?
Right.
So I try not to answer those questions. I try to find the stocks or items that have the best setups and then create stop losses for myself
Okay.
so that the stop loss prevents me from having to answer the second question.
Okay. Okay.
That's the way I think about it, just because I don't know how to do it otherwise.
Right.
I just don't know how to do it.
Thanks, John.
Thank you for the question. You're welcome. Thanks, Roy.
Bill Williamson, who's one of my favorite friends and guests. He's 91 years old, and he's the longest can slimmer in the audience tonight. Bill, what comments do you have regarding where you think the market is, Bill? And how would you describe an event or a scenario where you would think that the market is bottomed just from, it could be anecdotal or factual information? You're on mute, Bill. You're still on mute. And you're still on mute, Bill.
Yeah, can you click on him and hit the click on his picture and ask him to unmute, see if that prompts him?
Is that better?
There, now we got you. So, Bill, the floor is yours.
Well, I think I'm at a period in my trading instincts that I don't want to put a lot of risk on yet. What I try to do is write down all the things that I think or what I consider to be favorable these days and what's unfavorable, and try to do an anecdotal summary of who's winning on that front. And it's hard for me to put much risk on right now. I just don't have the instincts to do it. I feel like I do think that the thing that I'm looking for all the time is every day news comes out on stocks, and every day something comes out about the Fed or something. And I think the most important thing for the people on this call to remember is what happens to those stocks or the market when the news is bad. And if the stock does not go down or goes up, that gives me more confidence to buy stocks that are setting up to be long and put risk on. But I'm just not seeing, and also seeing a lot of stocks break out and fail. So I'm sort of holding more cash than usual, and I have a few longs that I think I'll probably stick in that are not big cap stuff, you know. So I'm watching for the news from the Fed and other places that everybody else is, and then how does the market react to it? I think in my mind, and have been in this business as long as I have, a lot of money is out, and the glass is probably half full right now as far as water is concerned, and as far as buying power we've got plenty of buying power out there. And but I do think the water, I don't think it's ready to fill up the glass yet.
Thank you, Bill.
Thank you, Bill.
Yes, sir.
Roy, can you use your Market Smith, and can you just put up the chart for Rio, please?
I can.
I want to see what Market Smith rates it on a relative strength basis.
And
So 92. Okay, thank you. And can you try FSUGY, please?
that's not coming up
Oh,
because,
okay.
but BHP,
BHP probably will.
yes, there's BHP.
93. Okay.
I mean, it's interesting that these stocks are very close to breaking out, and we're at the bottom of the bear market. I mean, this is what leadership looks like, you know, definitely. And building the right side. I mean,
John, do you care about volume just because, you know, noticing that volume's not superb on the last, week move up?
So I'm going to answer you as follows. I've read a lot of volume studies, and I've never found one that enables me to determine how to use volume properly. So I've often thought of it like this. If volume explodes and I own a stock at 10 and it goes to 20, I'm pretty happy. But if volume doesn't explode and I own a stock and it goes from 10 to 20, I'm probably still as happy. So I know volume is somewhere on my balance sheet of technical inputs. I just don't know that it is easy to characterize as bullish or not bullish. If it breaks out and there's big volume, it's terrific. But if it breaks out and there's not big volume, maybe it's not as terrific, but it's still pretty darn good. So I don't know how to use it. I would feel tremendous if I had 6 meetings today and every one of them said that they were going to buy iron ore stocks, but not one of them said they were going to buy iron ore stocks.
Oh, that's important. That's anecdotal. John, let me ask you, do you use, and speaking of volume, point and figure analysis doesn't use volume at all. It's just
volume,
trend,
right?
Which is,
Right.
Which is a great technique, if you will. Do you use candlesticks or point and figure analysis, or just daily bar analysis?
I don't use candlesticks or point and figure. Not that I dismiss them, I just don't use them regularly.
Yeah.
And I think when you bring in something you don't use regularly, your audience can tell. But I believe I try to use longer term charts more than I do dailies, because I believe the better signals come out of monthlies relative to dailies, right? Because in order for a monthly to get generated to, kind of affect a particular move, the dailies have to push it. But the monthly breakout is really usually, or the breakdown, really the most powerful signal. More powerful certainly than a daily. But the dailies feed the weeklies and the weeklies feed the monthly, and that's why I think the monthlies are the most important ones. Also, the monthlies give you the most perspective that you can't get on the dailies.
Right.
I also think, and this is just my supposition, that algos focus on daily charts. They don't focus on monthly charts. So I think as investors, we can make a difference by taking a little bit of a longer term view relative to a shorter term view, because the algos operate on a daily basis. I don't think that they operate on a monthly basis.
John, these stocks that you just mentioned, these 5 stocks that you just mentioned, they're close to making 52-week highs. How often do you observe the 52-week high list for
Every
your
single
clients?
day. Every single day. The 52-week high list provides tremendous clues, and clues are especially important when the 52-week high list is dominated, or at least provides the opportunity to see a bunch of stocks in a particular group doing the same thing. So, for example, and it's not happening now, so we can make this example, but if the 52-week high list is dominated by semiconductor stocks, we can probably be certain that there's a semiconductor strong trend going on. Similarly, if the 52-week low list is dominated by semiconductor stocks, then we can figure out that there's really a problem for semiconductor stocks. So I do pay attention to the 52-week high list, because the 52-week high list is populated by items that have strong fundamentals. It's just that it's identified as a 52-week high. So I do watch it every single day. And I count the number of 52-week highs. In addition, I have data for a long time that goes back a long time for the NYSE with respect to 52-week highs and lows. So that's really a key indicator for me.
In your experience, it's been the times where 52-week highs have far exceeded the 52-week lows. That was an easy dollar environment, I would guess you would say.
I would also say that when 52-week highs are much greater than 52-week lows, that you're in a bull market. And forgive me, but you probably don't need very much else other than that 52-week high list. In fact, you said it today, and I'll say it here. This is not advice. This is just a suggestion. If somebody was running a portfolio, a big portfolio or small portfolio, and they counted how many of the stocks they owned were on the 52-week high list and or the 52-week low list, they probably get a good feel for how strong or weak their portfolio is. It would probably be a lot easier for them to add to stocks based on what Will said earlier, or get rid of stocks. You want to sell the ones on the 52-week low list, the ones on the 52-week high list you want to add to. That's your strength. You want to average into winners, not average into losers. But using it on a portfolio basis is a good tool for figuring out how strong your holdings are. If you own stocks and none of them are at the 52-week high list, either it tells you that you're not in the right sector, the right stocks, or the market is deteriorating. Right? There's only a few things to conclude if your stocks are not on the 52-week high list. They're not the strongest ones. Maybe they're building, or maybe they're just really poor performers. That's all. It's quite objective.
John, everyone that we listen to on, these market pundits that you have on TV, they're always advocating buying Apple, Google, Apple, Google, Tesla, Amazon, and those companies. Do you think these stocks have much further to go, much further downside, or are they just going to go sideways here? Microsoft, when it peaked in 2000, took 16 years to get even.
Yeah,
that's of course my view in stocks like Tesla, where you have all this overhead resistance. But do you have more downside on the charts on Microsoft and Apple and Amazon and Google and so forth?
Okay, so I'm going to answer you in two ways. I'm going to put up my longer term charts because I've kept my notes that have been on the charts. So
Great.
Amazon, my first downside target was 100, and then my second target was 75. It got pretty darn close on the downside. I think it got to the low 80s. But Amazon certainly can rally here. It can rally back to 100, but I would be a seller in that area. And I think it's important for your audience to know, despite the fact that Amazon went from, let's call it, we'll make it easy for me, 190, and we'll make it again easy for me, down to less than 90, so it's down more than 50%. There's only one sell rating on the stock on the street. It's an underperform, where the target is 80. So that was kind of in line with my target. There's 55 buys and 1 sell for Amazon. So I don't necessarily believe that the street has capitulated.
Yeah.
With respect to Apple, there are 36 buys and 2 sells. With respect to Google, there are 46 buys and 0 sells. And Microsoft, there are 52 buys and 0 sells. So I don't know that these stocks have much more price decline, but I certainly believe that their price advances are likely to be unsatisfying and probably disappointing. And I don't know that the trend goes sideways for as difficult, Roy, as it was, as you pointed out, for Microsoft from its peak in 2000 till it finally broke out in 2016. I don't know if it's that long, but I think it will be longer than what we've seen so far.
It's interesting if you look at these charts, you look at them on all 3 time frames, the daily, weekly, and monthly, it all tells you something. But most notably, it tells you that all these stocks are in steep downtrends. They're in stage 4 declines.
And Bill O'Neill's Market Smith relative strength ratings would tell you right. So Microsoft has a 26. And again, I'm just doing this because there's a great juxtaposition. The iron ore stocks you put up all had relative strength ratings in the 90s.
Yeah.
And these other stocks, these former behemoths, or these continued still behemoths, but still tremendous historical performers, have very poor relative strength ratings. I think there's a message there.
And the danger in, of course, buying these stocks down here is they could rally. Any of these stocks could rally 10, 15%, but then then it's dead money. And if you're locked into that, you're going to miss the stocks like the material stocks that are breaking out to new highs that can go up 50, 100, 200% over, the next year, 2 years, while something like Microsoft and Amazon and Google, they're all going to underperform over the next couple of years.
I think the performance is going to be difficult, and it would. This is this is my imagination. So please, I have nothing to prove this. This is merely my imagination. I wonder if in 2023 the metal stocks can be like energy was in 2022. The energy stocks. I can't prove that. I don't have any historical basis for saying it, but that's kind of what my imagination. That's where my imagination gets to. The energy stocks were about 2.5% of the S&P 500 at the beginning of 2022. Now they're about 4.7, 4.8%, near 5% of the S&P 500. The mining stocks within the material stocks are only 2.5% of the S&P 500. What are the mining stocks? 0.5% of that? I mean, the mining stocks we went over, they're not even in the S&P 500. Freeport, McMoran, and Newmont are the two biggest mining stocks. I don't know if they're 1% of the S&P 500. So maybe there could be an important move for these items. I don't know, but that's kind of the way I think about it. Roy, I'm going to ask if I could turn in here, and thank you for your time.
Okay, John, thanks very much. We appreciate having you on.
And I just want to say, I promise I'm not being difficult, but I'm not going to be able to send out my chart packet, but I hope it was enough to share it with your audience.
For sure. We understand the compliance issues there.
Thank you very much. Roy and Wes,
John.
always a pleasure to be with you.
Right.
Thank you for
Thanks,
being
John.
friends.
Talk to you soon.
Thank you. Thank you, sir.
John. Yeah.
Thank you. Thank you.
Now, that was incredible. I hope you guys enjoyed that as much as I did.
Roy, this guy was great. I liked the way he handled things. He has his own style.
He does.
Everybody has to do what they do a lot of work on. Everybody does work on stuff, and nobody's got the answer to everything, you know?
Right. I agree.
I have one fund I'm in who is really bullish on these these iron ore companies like Masabi Iron and so forth. There's something going on there that I don't know exactly what is going on, but I always thought of as being a cyclical stock. But
yeah.
But I tell you, there's some big money looking at iron ore stocks.
Yeah, Bill, it's interesting that if you take a look, and we can go through a few of these stocks if you want, but we had your typical growth leadership in solar, biotech. Those, as you know, Enphase came unglued. That was our worst trade of 2022, where we doubled up when the stock made a new high at, I think, 293. ENPH. Do you guys see? Are you looking at my screen on Enphase right now?
Yeah.
Okay, that was our worst trade of 2022. We owned it and we were profitable. We doubled up at the pivot at 324.84. The market's very over sold, and so it was the first stock coming out making new highs in growth, and the numbers are incredible. You can see you've got triple digit numbers. And yet it turned over and we sold it around 300. And you can see what happened if we didn't sell it at 300. It's dropped 100 points from the high. But Enphase was one of the leaders out there. You had NBIX that was holding up, and it blew up yesterday. Regeneron, REGN was down 32 yesterday. Who else? Brad, did you say?
Suave, Shockwave.
Yeah. So these are all prior leaders, and this is just, you can see the volatility in all these stocks. LNTH. I mean, look at this, from a 52-week high, triple digit numbers, and yet the stocks are way below all the moving averages. And I think that one of my main takeaways is that I'm looking from John's presentation is I'm looking for stocks where relative strength that's in the 90s, and watching the new high list, looking at relative strength over the 90s. And you don't have a lot of stocks that have great patterns. So there's not a lot of merchandise to pick. So, we're just rotating. Here's Cigna that was at a 52-week high only a month ago, leading the charge. And this stock's come in 40 points. Humana, you can just look at chart after chart that made 52-week highs. So all these breakouts have been failing. SMCI, which had great numbers, and this stock reversed yesterday and then had a lousy break today. But look at that move from 92 to 75 in 24 hours. So 95 to 94 to 75. That's the kind of volatility that we want to avoid. So the market is still fixated on this volatility, and we're just rotating. There aren't many stocks that are making 52-week highs that are keeping their gains. There's ELF, which has been one of the biggest movers of the bull market, and look at the reversal in the last 2 days.
Hey, Roy.
Yes. Hey, Larry.
Hey, I got a question for you. One of the key metrics in all of these stocks that seem to be failing is large debt. Going forward, when we're going to look to even though these numbers are, a lot of these companies that you're saying that have these great numbers, but they're reversing, do we also know what kind of debt these companies have to be able to try to, let's say, add that as a factor in the decision making in addition to what we typically look at?
It used to be something that Bill O'Neill, just in your typical growth companies, you looked at. You wanted companies that had very little debt, but over the last 20 years, that's not been deemed as important. It will reflect, the debt will reflect in the earnings report as an interest expense. And, I think that's more important, your earnings per share growth than actually, the debt that they have. But, earnings stability, that's a parameter that you can get off Market Smith. And, lower debt typically provides higher earnings stability. So.
Right, but I'm talking about with respect to what we've seen with some of these companies that have been crushed. These are all highly leveraged companies.
But do you have companies in mind? Which companies do you have in
all
mind?
these ones that are down 80%. EP&H, weren't they one of the big ones? And a lot of these others that are down 80%, they're great companies, but they're leveraged and surviving because of cheap money, and it doesn't cost them anything to carry huge amounts of debt. Now these to use Warren Buffett's line, the ocean's coming out. We're seeing who's got pants on, and it's these companies that don't have huge debt interests that are surviving. And do we want to? The question I really comes down to is, do we want to consider that going forward, because we still are in for our environment, a high interest situation?
I think, rather than look at the percentage of debt to market cap, Larry, it's easy, and CanSlim return on equity is one of the important measurements to look at. And, return of equity over 17. If you just take a look at that encompasses, the debt part of the equation. It's going to impact earnings, and it's going to impact, return on equity. So
when you say that on this particular stock, we have return on equity being 74%. Explain that to me.
What they're making a lot of money. Net income divided by the market cap.
Right. So that's return on equity. That's not.
So this is a company that has tremendous financial platitudes. And, you certainly, just look at the earnings growth where you've got triple digit earnings growth the last 2 quarters. And remember, they're going to be a beneficiary of, what was it, Wes? It's now is it the IRA inflation? That's it?
Yeah.
Plan? Yeah. So, the government is providing subsidies for clean energy, about $3 billion, and these companies are going these companies are going to benefit from that. And that's why it's shocking when you look at the fundamentals, why the stock is correcting like this. But when you take a longer term view, take a look at it this way. When you see a stock that's gone from 1 to 300, it could be over. So, and it could be having peak earnings right now. Stocks peak at peak earnings. So this could be the market, the sell-off right now could be discounting peak earnings and discounting that, the stock can't go any higher just because it's come so far. It's hard to believe that the stock will go, from 300 to 600, in the next year. I mean, anything can happen because the fundamental backdrop is quite positive, but that's why the stock is pausing here. It's coming in, price targets are 350, 330 to 350. It's coming in because it's moved up so much, and it was heavily owned. Everyone owned this stock.
Hey, Roy, this is Amit. I think
Yes, Amit.
You said right. It's when everybody's getting crowded into one stock or one sector.
Yeah.
So, like, from a, all these stocks that we reviewed, they all kept going higher. Everybody was buying. They were supposed to be the new leaders, and then there's a rotation. And from a debt perspective, if you look at the big tech companies, so Apple, Microsoft, Google, I mean, they have so much cash and no debt, but they are also kind of getting into this rotation. Few months back, they were considered as safe bets or hedge against whatever you want to call.
Right.
And, people that was the place to hide.
Yes.
And now, so they kept going up and up. Like Apple went from $2 to $3 trillion with no major product changes or no significant growth in revenue or margins or profit. But it was just crowded trade, and then these people came out.
Well, that's a great point, Amit, and it just shows you as well that we're in the early stages. If we're in a new bull market, we're in a new confirmed uptrend, but we don't have a wide range of stocks making new highs. I think the new high list, it was like I had like maybe 50 or so when I looked at the new high list earlier today. So we don't have, but it's just starting. We're just right at the beginning, and the new bull market's not going to be led by all these stocks, and these stocks are still very expensive on a valuation basis. They're still very expensive, particularly if the numbers are going to come down in companies like Google and Amazon. So I mean, Amazon, there's Google estimates are down 6% last year and only up 10% this year. That's avoiding a recession. So, if I think I shared with you before, I think I got this from Ned Davis Research, that when inflation was running at 5%, the market traded at a 12 PE. And when the market was, when inflation's at 3%, it traded at a 15 PE. So we have plenty of more downside if these stocks roll over. And just the way the companies work in terms of there's negative operating leverage right now, and what that means is companies they're starting to lay off people because demand is waning. So that's the first thing that companies do going into a recession. They lay off workers. It's the last thing they do. They lay off workers, and then typically the stocks bounce on that news, but that's very short term. And then as the economy weakens further, they have to lay off more and more people. And so that's what we have to be prepared for here. Like I've just put up Lululemon. So there's Lululemon's chart where they warned. So they warned, and then the stock came unglued. It was down $30 yesterday because they pre-warned again. And so when the first time that you have negative news on something, it doesn't mean that it's over. So we have to be very careful in these stocks that are over-owned, and people on TV are buying them because they're quality. They're only quality if they go up. So, and they're still highly valuated and they're still crowded. And as John mentioned, nobody's got sell ratings on these companies. So we're going to have to go in big cap tech. We're going to have to go through the sales cycle. And that's a worst case scenario. If we go through the sales cycle, or the analysts have sell signals on these, they're going materially, they can go material lower. They're not going to be discounted the first time that they miss. It's going to take a quarter or two before those bottom, but the individual market, those will be bottoming. And that's really what I hope is, I hope that all these big cap companies get hammered, and you'll be able to see who the new leadership is, because those are the ones that are going to have great relative strength, high relative strength, and they're going to be holding up better than the overall market. And then you'll be able to find those stocks that can double and triple. I don't know who those are yet.
Hey, Roy, I've got just a question on John's outlook. I've seen the same things that he's seeing, and rather than try to buy individual stocks, I just took a small position in ETFs, metal and mining and emerging markets, and those, because the way this market is now, you can wake up one morning and like ELF, you're down, 10 or 15%. And at least if you have an ETF, if he's right, you got a little bit of time. And granted, you're not going to make as much money, but if this thing pans out into a longer cycle, you can branch out of that ETF and sell that and invest in stocks. But you get hammered so bad with a big drop in all these, like Enphase and all these other ones, and Shockwave, and pretty soon you get an accumulation of negative returns that, if you're right, then you're lucky if you get back to even. And I think maybe in this market to play some of the ideas that he's looking at. As a matter of fact, I took a position in what you've got up there, the metals and mining, the S&P metals and mining. I took a position in EEM. Okay.
Yeah.
And if you look on stock charts, they've got all the ETFs for the European and Hong Kong and these world indices, and all of them have really jumped up since the beginning of the year. So it leads me to believe that something's happening and there's some upside, but probably the best way to play it would be a position in an ETF so that you're not slaughtered, and then you can branch out if you see this thing materializing.
Well, I think that's really wise. And Wes and I were talking about this earlier, where I think that we've been stopped at, when we dipped our toe in, we got stopped out of everything, from Celsius to just all these names, PI, SMCI.
I've tried a few of them, and I end up losing a little bit of money. But to me, it makes a lot more sense to try to pick up some of these major trends. And if John is right, it's going to last longer than a couple of months. And at least you've got some buffer going in, and you can branch out into the Rios and the BHPs and the Valets and all these other ones if you see it's going to work.
We're thinking that you should just buy the S&P 500. Say the market, if the market firms up after Thursday's CPI report, if the market firms up, you get crossovers, you get above the averages, and you want to put exposure. I think the safest thing to do is to just add the S&P 500, not necessarily the Qs and
Yeah,
not
yeah,
necessarily the
you can just
Dow
buy the-
because you got
yeah,
30 stocks.
You could
But
just buy the RSP. I mean,
yeah,
I think you're better off with the RSP than you are the SPY.
yeah,
If
and
you-
that's a good point. So you have the RSP, which is an equal weighted,
Right.
that's the equal weighted S&P, which
Exactly.
makes sense. And also we were also looking and it's liquidity. You've got liquidity here, but the QQQE is equal weighted
Right.
on the NASDAQ.
Hmm.
So, but look at the volume there. See, so I mean, if you want growth stocks that are equally weighted and you don't have all the FANG stocks there, this is a great instrument. But look how thin it is, 124,000 shares, average daily volume.
Right.
But you could put, I mean, we can't put 5 million in that. We can't.
Oh, I know.
But you can put 100 grand, 200 grand, in something like that, and get that diversification, and also have the upside, and in the growth stocks. Oh, look at that cat! Look at that cat! That's so cute.
But I really think until this thing sorts itself out, you're almost better off to take the trend in the form of an ETF.
Yeah, I agree.
Take a smaller position, and then you can branch out if you're right, and you don't get slaughtered if you're wrong.
Neil, what kind of positions are you taking, and how invested are you right now?
Well, I'm about 40% invested, but the majority of it is I've taken smaller positions in EEM and the mining and manufacturing. I've taken positions in Boeing, but I'm sort of trapped in the Microsofts and Apples and Lockheed Martins and Duke Powers and those. I've got such a low cost basis in it that, I mean, I finished the year. If I had sold out of everything last year and paid the taxes, then I finished the year slightly above that at this year, and I've muddled through. So it's sort of, it's sort of a catch-22. And once you get yourself positioned like that, it's a hard call. I'll be honest with you. I really didn't know what to do. I mean, when you're sitting there looking at a tax bill and you're saying, my gracious, and I mean, I got $38 a share in Apple. Okay.
Yeah.
And so you got to decide what type of game you have to play.
Yeah.
And that's the whole situation that I've caught myself in. I mean, I feel very fortunate because I've made some great buys over the year. I mean, I got $50 a share in NVIDIA. And Lockheed Martin, I've got, I think, 178, and it's 400 and something.
Did you write any covered calls in NVIDIA? How do you handle NVIDIA?
I do that. I do a little bit of that. And but I've got such a low cost basis that, I figured, well, sometimes the calls can be a catch-22. You start writing covered calls now, and you you get a good CPI report on Thursday. It goes in, and you get pulled out of it and everything. I'd almost rather just take stuff off the table and keep reducing my cost basis so that so I can't lose any money. And I mean, about what I've got in the market now, 2/3 of it or 70% of it is house money.
Yeah.
And so, and I don't want to, and I don't get above that. I try some new positions, but I found out that you just get slaughtered in them. And that's the reason I stuck with the ETFs on the new positions, because it gives you some room.
Are you tempted, Neil, in buying any NVIDIA down here?
No, not really, because I don't want to raise my average cost basis. I mean, it's $51 a share, and I don't want to raise it. Okay. And like I say, Apple's 38. I don't want to raise my cost basis in Apple, and so I'm not tempted to do anything. What I will do, if it keeps on dropping, I keep taking the higher price shares off and keep reducing my cost basis so that I keep the margin there. So,
Neil, most of your gain and I'm just looking at the video on the monthly, and and it's a difference probably in I guess strategy, buying the pullback or buying the breakout. But I'm guessing you made most of the money in NVIDIA when the stock was making a 52-week high and we just had a 2-year run in it.
Exactly.
So
I mean,
that's,
I'll be honest with you, I've given back quite a bit of profit in NVIDIA.
yeah.
But, and I've taken, I've reduced my position about a third. Okay. And so that's where I'm at.
But guys, let me just say that that's the environment we're waiting for. When you look at that NVIDIA chart from 2018 to 2019, you had a tremendous drop, 71 in that bear market, a 50% correction. And then, when it got above the 10-month moving average after the correction and above the 30-week moving average, which was turning up, that was the time to buy it. And, we don't, and the great stocks have a nice uptrend. They pull back and then they make, cup and handles or take out the highs, and then you have a couple of year move. We don't have a lot of stocks we don't have a lot of stocks in the last year that have been uptrends. So the market environment's not right yet.
It's not right. I mean, I feel very fortunate to have caught the market environment right.
Yeah.
But it puts you in a predicament as to what to do when you have a correction, and the correction could go farther. Well, if the correction goes farther, from my situation, I'll just lop off the highest price shares and reduce my cost basis, and I'm still out with a profit, and I still got a margin there that, at some point in time, some of these companies I think they'll be around and they'll be good. I mean, I sort of just forgot about those companies and trying to get new ones, but the new leaders that I've tried, I mean, I've been fortunate on Boeing and Nike and a few of the others, but anytime that I get a high PE stock, it ends up like an ELF or a Shockwave or some of these others that just get massacred in a day. And that's the reason I said, okay, I see the trends that John's after, and I'm much better off with an ETF. And that's where with EEM and, the stuff overseas, you can't really buy individual stocks. You can if you know what to buy, but that's adding a lot more complexity to your situation, and so the simpler you can keep it, the better off you are, I think. So
thank you, Neil.
Yeah, I didn't mean to dominate the conversation. I just was asking
appreciate
about
it.
The ETFs. So
no, thank you so much.
Yeah.
Right. One of the ETFs that are mine is PIC, PICK.
PICK. That looks definitely like an interesting chart. You can see the relative strength line is breaking into 52-week highs. It seems like a timely presentation by John Roach, because you can definitely see this area is perking up here. The group strength is still poor, but it's definitely moving up when you look at the relative strength line. So it's building this right side of the base. So that's very interesting. Thank you. Comments, or do you guys want to pull up any other stocks?
Boy, this is Bill. I look up DKS, Dick's Sporting Goods.
This is interesting, because the relative strength is so high. It's 92, and it's sort of counterintuitive, because the stock is performing great, but the numbers aren't that good. What about ASO, Bill? Are you still in ASO?
No, I sold that. I did buy back a little bit of Dick's.
You did.
Because I wanted to be with the biggest and best in the industry.
Okay.
But I'm a little nervous about that position. I'm probably going to sell it early. I'm just not going to sit around and wait and let this thing be a loser. It's in the retail business, and they sell sporting goods and everything related, and that's a hot area right now.
Man, look at the base on the weekly. I mean, you've got a great base, and I mean, it hasn't, it's gone sideways for a whole year, basically. And, you've got a great base there on it.
Well, it's a cheap stock at 10 times earnings too.
Yeah.
So I don't like to buy stocks for that reason, but I mean, that's a reason why it might not get killed, unless there's something, if something goes wrong, we'll have to get stopped out of it,
Yeah. Yeah, that's an interesting chart for sure. And I look at how much this stock has gone up now 1, 2, 3, 4, 5, 6, 7 out of 8 months. So that's accumulation right there. It's certainly not selling pressure after it bottomed.
Yeah. I'd like to see more volume. I'd like to see this stock break out to a new high on heavy volume. But it just, it's going to take some while for that to happen.
Yep.
Look
Thank
at
you, Bill.
this on the monthly chart.
Right here. It looks favorable, looks good. Particularly if we get a move, again, coming out of a new bull market, it's going to last. It's going to be a multi-year, presumably a move there. Look at the move here this stock went up 1, 2, 3, 4, 5 years, went up 2 years. It's gone sideways. So if you take that out, that 52-week high out, game on for sure.
We need to see more of this happening. We're not seeing very many breakouts.
Yeah.
That hold, that's why I said earlier, 20 minutes ago, that I'm holding my biggest position now is 91 trade Treasury bills.
Yes.
I just don't see enough breakouts holding or carrying through. It's just too hard,
I see very few. I mean, very few. This is a stock that's got really exceptional earnings. Bank of America's got a $200 price target on it. Earnings are expected to be up 188%. They've got a number of drugs that you can read about, primarily in the hematola area, I believe. And the numbers are really good, but when you look at what happened with the stock in the last 5 days, stock closed at the low 100, closed right at the bottom, ready to go. And this was when biotechs were really rolling over. The stock had a big gap in reversal the next day, and then went up 2 days, and you had this nasty reversal yesterday, and then it followed by a reversal of that reversal today. So I call that a Kaiser Soze reversal. So it reversed yesterday, then it had a total outside day to the upside at making a 52-week high. And this is the volatility that you're seeing in this market. But keep your eyes on this one, because it's one of the first stocks again in biotech area that's making a 52-week high again. But that group's been, extremely volatile lately, holding up, and then they correct.
Roy, can you look at Crocs? Kind of one that everybody knows is kind of making a nice right side of the base. But if you look at the daily, it's had the past 2 weeks, the closing on it. Every single day it closes on the upper. They're like little hammers running right across the 8-day.
Yeah, I heard. Who did I hear? I heard a famous market pundit once say that every new, and this kind of, it fits into that sporting goods thing, that every new bull market is led by a shoe company. And there's Crocs, which has done great from the low. And then you've got Skechers, SKX, which is a 93 relative strength. I mean, these stocks off the bottom, Crocs, Skechers,
Deckers is in that group too. Deckers.
So there's Deckers right there. Look at that. So this is kind of interesting that we've had one of the worst bear markets in history, and you've got shoe companies that are leading the way. And I'm sure Crocs at this time, they've got a wide range of products, but maybe it's up because it's a defensive area. A company that I was looking at is ON. That's a high, high price shoe that's very, very popular. And it was an IPO. And look at this style, look at the accumulation that just took place 2 days ago. So it hit my screen, and it's right there with tremendous volume, no news, just accumulation. And now it's breaking over the 200-day for the first time. So this looks like an early turn of an IPO in Eve Bobbitt and Kathy's book, The Life Cycle Trade. So this is an upscale. Earnings are going to be up 27%, just breaking the 200-day. So keep your eyes on this one as an early turn from the IPO.
Look at the sales on that thing too, Roy.
Man, these are terrific sales. And look at they have easy estimates too. Look, and what's nice is look at the sales rises in subsequent quarters. Bill O'Neill used to like stocks that had 3 quarters of accelerating sales and earnings, and this is exactly what's going on there with this one. Great sales growth, great earnings, and a new company. Companies like this is where you hit home runs. But it's a different type of setup. It's one of these IPOs that are washed out type of setups. And another one in that, another IPO that has got our attention is this Shift for Payments, FOUR. Yeah. And look at this company. Look at the earnings estimates, 196% in 2022 and 51% in 2023. 400 million, 401, 506, 547, and they have an easy comparison coming, and they're knocking it out of the park. And see, this was an IPO that just got over the 200-day. See, back here a month ago. So watch that ON to see if it plays catch up. And we actually bought it. You see this trend line? So we bought this stock right there above this trend line and got kicked out that day, and we took an 8% loss, 8 or 9% loss in it. Bought it right there and got shaken out. But we had to, that was the environment that we're in, and we had to take our loss. But now look at this stock firming up here. So, and these stocks coming out of the IPO, see, this is exhibiting leadership. It won't really go until it breaks to a 52-week high, but you're seeing the last 3 months of great action. So I really like this stock.
Hey, Roy.
Yes.
It's Larry.
Hey, Larry.
Just some context here. We're talking about a lot of great stocks, and I agree with everything that you're saying. But in what was happening, let's say with John's conversation and yours and Wesley's earlier, we're not in a market that looks like it can support any of this by any term. Shouldn't we just stick our conversation to, let's say, the gold and copper stocks and the ore stocks and the material stocks and the things that are going to work right now in this market, and then hold these back and when the environment becomes more favorable?
It can turn in a heartbeat. It may turn Thursday, Larry.
We're just saying we could be ready. We should be ready.
Yeah, we should be. We have enough time and magnitude. So we had enough duration in this bear market. We've had certainly magnitude worthwhile, and particularly if depending on what happened, but we don't know what the Fed's can do. We don't know where the economy is going to go. But these stocks are going to bottom before the account, like FOUR bottomed. So it bottomed 2 months ago, 3 months ago. So even if this, even the market rolls over, this stock's not going to take out 36, 33. It may come in, but the environment is so volatile that if you bought it right here on the breakout at 60, that if it goes to the 21-day, that magenta line, you just lost 12%.
Right.
And so, and there's nothing, there would be nothing wrong with this stock if it comes into the 21-day. But
it just, like it was
it's
at
just
3 days ago.
extended. It's just extended.
Yeah. No, I hear you loud and clear. Now, with that said, given if the Fed does what you're preparing for, will these other stocks these ore stocks or coppers and golds, they'll continue on because that's just the nature of where we are in that cycle. Is that correct?
I don't know, because, someone made a comment earlier about, and John didn't bite because he's not a fundamentalist. He's just looking at the chart. See, I can't understand if if we go into recession, why you would have excess demand for steel, copper, and metals.
Well, he answered that very politically correct. Is there something else in the chart that we just don't understand?
Yeah.
The chart's telling us this is what's happening, and our typical metrics can't explain it. That's what I got out of it.
Yeah, that's true. I think you echoed that, paraphrased that perfectly. So
I'd like to add to that as well.
Go ahead, Brett.
There's got to be something said about housing stocks being the best performing stocks.
Yeah.
Best charts out there, the past few weeks.
Yeah.
I mean, they look immaculate, and maybe that has something to do with, materials and housing, and maybe it all melts together, perhaps.
And these prices have come down too. I'll pull up on FinViz. I'll pull up lumber, and I believe lumber's come way down. Let me move this over. But look at, you would expect that housing would be getting crushed. There's the ETF for housing. You would expect it to be getting crushed. Why is it not getting crushed? Is it because there's, because just like in Charlotte, there's not enough supply, even though, even though rates have risen.
But what's really interesting is that you listen to CNBC, and we're in a crisis. We're in a housing crisis for pricing, and we're looking at a free fall. So I don't know what to believe about housing.
Right.
Yeah. So look at this. Check this out, guys. Screen 1. Are you guys seeing the lumber price right here on the screen?
Free fall, yeah.
Yeah. Look at this. Where lumber has now, and people are expecting housing prices to come down, but, lumber prices have come down so much, and, you don't have any cost pull inflation here. Lumber's come down, which, they can still build affordable homes and make money in terms of their margin, the home builder margins. Maybe that's what's going on here.
Hey, Roy, you don't happen to have a statistic that's somewhere in that crazy brain of yours, is that what percentage of lumber is a real estate price? So, is this significant? Like somebody tells me, I think we had this conversation 2 meetings ago where a 5% wheat product was going up 100%, blaming wheat prices because it was 100% wheat.
Yeah.
Is the same thing happening? Was the same thing happening with lumber?
I don't have that at my fingertips or in my noggin.
Right, but there's a limit to what you know? Holy cow, I didn't think there was.
Roy, put Toll Brothers up on the screen, TOL.
Okay. Is it on the screen? Do you see it or not?
Yeah, I see it now.
Okay.
All
go
that
ahead.
volume is over the last few days is pretty strong. It's this thing is resolved out of this consolidation, and it's a long base.
It is. How do you explain, this is the luxury builder, nationwide luxury builder. And I don't know if that, and DH Horton is, a middle market, I guess, but is there any emphasis from a fundamental perspective that you see, Bill?
Well, the only thing I can tell you is the Toll Brothers, if you look at the type of homes they build, they're upper end, but they have a lot of lumber in them, and the price of lumber has plummeted.
Yeah.
So maybe their margins are going to get a lot better. I don't know. I need to talk to somebody who builds houses. Tell me that, what's happening to the builders.
But notice
how much of their costs are in lumber versus all the other stuff,
Yeah.
Labor's got to be a big deal for them, I would think.
The PEs in these stocks are quite low, actually, a lot of them.
Yeah.
And that would be interesting also. When you get these new market leaders, and the trend has changed, obviously, but you could get an expansion in PE. You could keep the earnings right here and just get an expansion in PE where people pay more for them, and Wall Street comes out and embraces them. And that's just one of the bits of art in terms of, getting on a stock that's a big winner. But the trend, it's only been going up, and the trend's only changed for 2 months.
Mm-hmm. Well, the estimates on Wall Street are very look like they're coming down on the earnings quite a bit the next 2 years, but that could be wrong. You see?
Yeah.
We don't.
Yeah, for sure.
I bought BLDR on the weekly. It's just I bought that yesterday actually. On the EPC, it looks like. If you look on the weekly, it's a nice looking chart on the weekly.
Looks great. It does. And this is I would pose the question right here is, look at the bull market moves that lasted, a couple of years in the past. And, this is the setup. You're right there about to break this downtrend line. And it's a group that that's under 74 out of 197. It's a group that's moving up for sure over the last 2 months. And it's basing, the relative strength's not there yet, but if the market sells off and the stock stays right here, you'll find that relative strength line rising. And I'd seen this stock myself. It hit my screens a couple of weeks ago as well. I think maybe when it broke out there and hit 70. But this is what I don't like about it. Look at the estimate cuts from $17 to $6.
Yeah, I noticed that as well.
Yeah,
So
I don't like. That's why I would buy it, because of that.
Yeah, I would. Yeah, I wouldn't. I would pass on it.
I'd have to talk to some builders who I trust to tell me something's changed. The chart doesn't tell us,
Was it Green Brick Build that was a builder that was it Green Brick or LGIH that you had traded before over the years?
No, the ones I've always been best in, DR Horton. I go with the big ones that are most active in the industry, because the leaders are where you want to be in that group.
Yeah.
Now, the Toll Brothers is upper end, and they're good operators. They know what they're doing.
Yeah.
But there's a couple of others that are really good companies. The best one sells for $3,000 a share in the Mid Atlantic. They're the Warren Buffett type.
Oh, that's who I was thinking of. What's that symbol?
I've forgotten. I've forgotten the name of it first. I can't remember.
I thought it was that Green Brick.
No, that's not the name of it now. This company is based in Maryland, I think, and
Yeah, I remember. Yeah.
around Baltimore, and I'm having a senior moment now. I can't remember the name of the company without looking it up.
I remember you discussing it with me. I can't remember who it was either.
And I used to own the stock and made some good money in it. So
Taylor Morrison looks good.
What's that, Brad?
Taylor Morrison.
no,
Yeah.
that's not it. Yeah, I don't think so. And they're a hell of a company too, Taylor Morrison. That's a merger with another company, Taylor Morrison.
Someone wrote NBR in the chat.
Yeah, that's the company I'm thinking about, NBR. Check that price on NBR.
Yes, I see it.
What's the trading at? About
$4,800.
$4,000. Yeah, I was in it when it was 3,000, and sold it. And they're the best company in the whole industry. And look at their margins, see what they're like, you know.
NVR. Bill, do you still
They're earnings they best to be to come down on the street.
Yeah.
29%.
This is interesting. They've got the highest PE too.
Yeah.
People are paying the most for it.
Yeah.
Bill, do you still have your Berkshire Hathaway?
Yes, it's my second largest holding. Yes.
And BRKA?
Well, I own both I own the A and the B, but more of the B, the lower price one. Yeah.
Didn't you buy 100 shares of this like 30 years ago?
Yes, I bought it so I could get the annual report. He would not let you have the annual report unless you had the stock in your lockbox.
I'd say that's been a pretty good ride over the last 30 years.
Yeah, well, I held it and I went to the annual meeting twice, and I just sort of, it's a kind of stock that you can live with because you know that he's a lot more value there than what the market is telling you, you know. Yeah, I'm in the camp that when Warren is incapacitated, I can't run it anymore. I wouldn't be surprised to see this company somewhere along the way get broken up.
Yeah.
And these new guys, these young guys that are in there, and I say young, they're 50 now, but and they'll carry it on like Warren wanted. But I just think that there might be some of those businesses could be sold for a pretty big price. Now they do have no cost basis, and so there are some tax issues there too on that story. But I don't know.
Bill, I'm 65 and I'm young compared to you.
Yeah.
But, you know, I didn't buy Berkshire Hathaway, 20 years ago either.
Well,
maybe I can get it for the next run from 60 to 90.
Well, you basically, he's the money manager for me for this money. I'm not, that gives me confidence. These guys know what they're doing, you know?
Yeah,
so,
for sure.
And they went into this Occidental, and I wouldn't have done it and bought it really right, Occidental Petroleum. I mean, they got a great knack for doing it. And they just bought a big company called Allegheny in the last 6 months. And that's a hell of a company.
Right.
So I don't know. I think if you just want to put something away and you can afford it, not to have a dividend, it's a winner. I'm not planning. Of course, I'm like we had a guest we had on the program a little while ago. I mean, if you got a stock that I bought years ago that's for nothing and they don't pay any, I don't need any dividends anyway. I just sell off some shares every year, but make sure I have enough money to live off of, And then whatever I accumulate in terms of wealth, I can always give it to my grandchildren for education, or I can also give it to my foundation I'm setting up under my will, to make gifts, charitable gifts and stuff.
Right.
So, as long as the law doesn't change about unrealized gains, I'm okay. But But I like to trade in good markets, but this market is just not good for that. I mean, it's just too hard. And So I'm holding a lot more cash than I used to do, yeah, for that reason. And I do the 91-day bills, maybe 180 sometimes, but I'm just trying to get, I'm not making that as a statement, it's just that I want to have enough money that I can live on for the rest of my life in the custom I want to live in, and not have to be dumping some great stocks like Warren Buffett, Berkshire Hathaway or something. Well, I still own a little bit of Duke Power Company at a low basis, about $2 a share. So why should I sell a Duke Power? Particularly if I die with it, it'll be a stepped up basis, unless they change the law to whoever when it comes out, and if I give it away somewhere other than charity. But I'm going to be, most of my money is going to be going to take care of my wife if she survives me. And then after that, charitable interest will be involved.
Thank you, Bill.
Roy,
Roy, hi, this is Ashok from Dallas.
Yes, hi.
We spoke with you and your son about a couple months back. I would suggest, if you're looking at Berkshire Hathaway, take a look at FinWiz and the next 5-year growth rate. And with the stocks they own, the projected growth rate is 23% annually.
Which company is? Which company?
Berkshire Hathaway.
Oh, okay.
I've held the stock since the first day they came up with the B shares. That's roughly 24, 25 years. Their return for the last 10 years have been very, very similar to the SPY, but I think they're going to do in the next 10 years better than S&P.
Yeah. Yep.
So if you're considering it, this is a good point to buy it. If you look at it, I think it's in a cup and handle base.
Yeah.
I was thinking of adding to it.
Right.
Well, the chart looks pretty good right now. It's setting up.
Yeah.
If the market turns up and we get a lot of volume on the upside and a lot of breakouts, so this stock will make a new high,
Yeah. And they tend to do well in bear markets.
Yeah.
Basically, it doesn't do as well. Its alpha is not as great as what you'd get in some of the high growth stocks, but its beta is pretty low.
Well, it's a big company now. It's just not going to grow like it used to. That's the downside on it. It's so big. Unless they break it up or something happens to Warren or his successor, I don't think they're going to break it up in a whole lot of pieces, but the government might break them up too,
Yeah, what other stocks, guys? I've got maybe 5 more minutes and we'll call it a night. So if you want to
take a look at Jeffries.
Can you look at CRPX?
Yeah. What was the first one?
CRPX?
Yeah. CPRX, you mean?
Right.
Yeah. I own this stock. I bought it like 2 days ago on the breakout, and then it failed. It squatted. I sold it yesterday, and it's got an inside day today. And what's intriguing about this stock is it does have a 99 earnings per share rank and a relative strength rank of 99. There are only two stocks in the universe that have that right now, and this is one. And they just acquired another company, so they've extended their runway. So it's the only company right now with the 99.99. So stock setting up, it's been a leader. It could be a leader. It's definitely on my. It would be one of the first stocks we would add for our clients if this market takes off from here.
Roy,
Hey,
we've talked about AEHR in the past, and it's been on fire.
So AHR semiconductor company, and look at the volatility, and where it was a thin stock, and by then, stock was only doing $10 million in revenue. So it wouldn't hit our screens in terms of, we couldn't buy it, $10 million in revenues. While the numbers are good, they're growing, at 50, the numbers are good, but it's a small company, average trading volume of 1 million shares. So it's starting to see some, getting a little bit better liquidity. And they did report earnings. So you could see that it surprised on the upside. So it's extended now. So it's one of the first stocks out of the gate coming out of the bear market. So I would definitely consider it as well. But it's extended here. It's not buyable, right here.
And if you own a fair amount, how much would you be selling off just because it can't just keep going straight up?
Well, remember, we're not providing investment advice. So that's an individual decision. Depends on, the cost basis, how much, your cost basis, how, where did, if you're up in it right now or down in it, and, I wouldn't let a profit turn into a loss after this move back. And from a trading perspective, and this isn't providing any investment advice, but I'd probably scale out of some and wait for a new, try to trade around the core position. But, this could be a big stock. So you got to be careful and not have FOMO if the stock, continues to go higher after you sold it.
Very good. Thank you.
You're welcome. This is one of my favorite stocks, Halo, Halozyme Therapeutics, but it came into the 50-day and we've been watching it. So, this biotech area has been weak, but they have a novel therapy in which it's an infusion product so that it speeds up the delivery of drugs, and they've got partnerships with Bristol Myers and other people, so that if you go to a cancer infusion company, it speeds it up. So instead of something that might take you 6 to 8 hours, they may do it in 1 hour because of the novel way that they provide the medicine. So it's got, look at the numbers, earnings are going to be up 89%, and they have easy comparisons, 102 million, 117, 152, 209. So they're growing, quarterly, they're accelerating. So let's just say they have 220, they have 220 million in revenues this quarter, this coming quarter that's reported in February. Revenue is going to be up 100%. See, so you're going to be accelerating. This is what leadership companies look like as well. This is on the top of our buy list. We'd be buying this as well, but we're somewhat, indecisive based on the market. But I'd say this would be one of our favorite stocks at the moment, but we don't own it yet. We're looking for an entry.
Is an ETF in that space worth considering?
IBB.
Well, it's IBB, but they're different companies. You got IBB and XBI, but
yeah,
this is such, I don't know, that company's got to be in one of those, but they're going to have the bigger stocks like Gilead and Amgen and Biogen.
Okay.
And those.
But are those ETFs setting up charts like we're looking at here on this company we just looked at? Halo?
No, they're not. The individual stocks are holding up better. There's Gilead that's holding up better, and actually Biogen is holding up, pretty good. It's just turned today, so you can look at that. So, and we might be in big cap biotech, and some of the leading stocks have been the underfollowed biotechs, but this is still, 91 relative strength with Biogen, and, these companies are profitable. They're big companies, and they've been going sideways for a long time. Look at this base. That would be a Brobdingnagian base on Gilead. This stock's going sideways for how many years? For 8 years.
Yeah.
And Gilead just signed a joint partnership with someone yesterday or today. And their partnership company took off. I forget who it was, but if you get a period where we were looking for leadership. Look, there's a 5-year run. 1, 2, 3, 4, 5, 6, 7 years, 7.5-year run. Once these stocks make new highs, see, this is where, and the timing's not quite ready yet, but there's a 1, 2, a 3-year run upturn. Once this stock, and see where it's breaking out of this, this sideways base. Once the stock gets to new highs, this is how stock, it's an $87 stock now, and $90 stocks go to 100. And once the stock gets to 100 and breaks out to a 52-week high, I could see this stock going from 100 to $300 over the next couple of years. This might be where the leadership comes from. So watch these stocks closely to see if they can get into new high territory, because these are big companies that have gone sideways a long period of time, and they've got products in the pipeline that they're just getting approval for. It's just they're not quite ready here. The bases are not quite set up yet. So we might just need time. I would think that this would probably be my number one idea in terms of, well, what would I want to buy for the next 2 to 3 years? It would probably be these stocks, but they're not going to get going until they break into 52-week highs.
Yeah. There are a lot of good looking stocks like that that are in a trading range.
Yeah.
Set up. One of them I like is Vulcan Materials, VMC. Victor, Mary, Charlie, VMC. It's typical of a lot of companies there. It went up, it's consolidating. It's in a hot area, which is construction of roads, bridges, and everything else that we know a lot of money is coming into that area. And it takes several years for the money to really flow in there, because they have to engineer all this stuff, before they can build it.
Yeah, so this is, this is, again, a major takeaway that I guess that we're sharing is we have to look for not your typical growth, but we need to take a look at, well, really what's working and what's got high relative strength, and where they have to be profitable companies. They have to be basing, and this is where the potential new leadership is going to come from. It's not going to be, these stocks aren't on the radar of most Wall Street people, and that's good. You want to get in there before Wall Street.
Put up the chart for Caterpillar, same thing, CAT, Caterpillar, same thing.
Same kind of thing.
Yeah.
It's right, that stock is right there.
Yeah.
So we're looking at Caterpillar and Deere as well.
Deere is the same story, yeah, except it's more oriented toward farming,
Yes.
and food, all that, yeah.
Guys, I'm gonna call it a night. I'm worn out, so I wanted to thank you for attending. It's thanks for your input. I hope that you learned something. We always learn something every meeting. It's Wes and I's favorite thing to do, to visit with you guys monthly. So we hope to see you next month, and hope you stay on our mailing list and contact Wes if you're not on our mailing list. So good night, guys. Have a great evening.
Thanks, good night. Thank you.
Good night, Roy.
Good night, guys.
Good night.
Thank you.
Good night, Roy. Thank you.